from 51,000 to 46,000, again recovered to 50,000. So a volatile swing of 5,000 points was seen, but again support-based buying is clearly visible. Some underperformance is there, but sustained buying interest on a small decline could take it to higher levels. So till it holds above 49,250, any small decline could be bought for an upside target towards 50,500 level. Now looking at the stock wise, we have positive view on the Nifty Auto segment, one of the strongest sector. Most of the stocks are doing well, including M&M, Bajaj Auto, Hero Moto. So here we are recommending to go long on Bajaj Auto. The stock is trading in an upward rising channel. It has respected to its 50-day mark, ready for a fresh leg of rally after the consolidation breakout of last 10 weeks. So one can buy with support of 94.50. Overall, we are expecting a run up towards 10,150 marks in this counter. Second trading idea, that is buy on Bharat Dynamics. The stock is continuously making higher top, high bottom on the weekly chart. We have seen a smart recovery in last few days. It surpassed its previous hurdle and set for a fresh leg of rally. So one can buy for an upside move towards 1490 with support of 1395 level. Last trading idea, that is buy on Divislab. Nifty Pharma itself is giving a breakout, and Divislab has formed a bullish pattern. We have seen a breakout on the monthly and weekly chart. Sustained buying interest is clearly visible. So one can buy with support of 44.25. And here we have a target towards 47.50 zone.
All right, Chandan, thanks for joining in. Wishing you a good day ahead. Well, let's focus on the defense theme. Bharat Dynamics is one such stock that's seen a big run in the last 12 to around 18 months or so. Some of these defense-related names did come in for profit-taking post the election verdict, but they have bounced back. Valuations are not very supportive as well. But to understand how Bharat Dynamics is shaping up and what's the outlook from here on, we're joined by Mr. A. Madhav Rao, the Chairman and Managing Director of the company. Good morning, Mr. Madhav Rao. Thanks a lot for joining in. Well, a quick comment first up. We have a coalition government, and some fears are that maybe, in fact, the kind of push that we saw to defense may not see the same in a coalition government. Your quick comment before we get to focus on the business itself.
Good morning, and thank you very much. It's a pleasure to be with you. Yes, the coalition government is a reality, but I don't see any great impact on the momentum on the defense procurements and the investment in defense.
Got that? So that's out of the way. You believe things will continue and the focus on defense and the impetus that we've seen will continue. Got that. Mr. Madhav Rao, let's focus on execution then. Towards the second half, I think, of FY24, there were some supply side issues. And that's why there wasn't that revenue growth that you were talking about didn't come about. So have the supply side issues got sorted off to some extent? And also, what can you guide us from here on? What's the revenue growth? What's the margins that we should be working with for FY25?
So for FY25, like you said, we had brought out that in the last 2 quarters of 24, we had issues on the supply chain part, which had affected our targeted sales. But however, we have done a lot of mitigation of that, and the global situation also has improved. And I see a lot of improvement, and we have started. Production has picked up. In fact, our production margins have improved Q4 of 24, and that momentum continues. What I can see, conversion of that into revenue will happen from the second quarter of this financial year. And that is going to be substantial, I would say.
Okay,
so
give us a number.
Quantify that, because I mean in the previous financial year, because of these issues, overall full year top line was actually down. It fell by about 5%. So now that you're saying that some of this will be resolved second quarter onwards, full year basis, what's the kind of top line growth we can expect?
I see about 20 to 30% of top line growth over the full financial year. I'd say, and the major part will start kicking in with the second quarter of this year.
Okay, so 20 to 25% top line growth. And on margins, sir, so the interesting part was that FY24, while your revenue was a little stagnant, margin profile really expanded. I think your year-end margin rate was almost touching 22, 23%. Is this sustainable?
Yeah, largely in our case, the margin is dependent on the product profile that you do in that financial year. So I would say that this year also the normal margin rate would be about 15 to 20% with respect to Bharat Dynamics, the EBITDA margins. And this year we will continue to have around 20%.
Okay, so I mean, good morning, sir. Prashant here. So you basically FY23 margins were about 16%. So you're saying that in 25 you'll go back to, as you say, between 15-20%, right? Not more normalized kind of margins.
20%, I would say.
Closer to 20%. Got that. The other thing is order book, right? I think if I look at order book as at the end of March 24 as opposed to March 23, order book was 19,500 as opposed to 21,900 crores. So it's actually about 10-11% lower, 24 over 23. Could you tell us what are your expectations for 25 in terms of order bookings?
In the case of defense, I think it's better to look at a 3-year block here rather than a year-on-year with respect to order books, because the execution timelines are at 3 to 5 years, and the orders which we get are in a cycle of 3-year cycle approximately. So what I would say is, if you've seen the order book position on 1st of April 24, it is about 19,500, and in the next 2 to 3 years, again, I see that we would pick up on the order books of about 20,000 crores cumulatively. So on the average,
you've taken fresh 20,000. You expect to take in fresh 20,000 crores in orders over the next 2 to 3 years.
Yes, the current order book, what we have is for about the execution will be about 4 to 5 years. So an overlap of that and cumulative, this one by another 3 years would be again 20,000 crores.
Got it, sir. So, that's on the ordering activity side. Can you just tell us what will be the order profile, just to understand? I mean, I believe the NAG, anti-tank systems, there has been a request for proposals over there. Then there is this air-to-air missile, the Astra missile. So just give us an idea about what will be the profile of your order book, and then margins, because you said, I mean, margins depend. In whichever quarter you're doing higher margin orders, the profile increases. So just tell us which are the higher margin categories for you, and what are you hoping to get in the bag this year in terms of orders? What kind of orders?
See, primarily what you said about NAG, we are very bullish on the order coming very soon. We are in the RFP stage. So any which way, from the defense stocks, it is not very good to talk about the products itself. I would not try to emphasize on which product, etc. But in general, we have the anti-tank guided missiles, the surface-to-air missiles, and the air-to-air missiles in 3 broad categories. I see that we are going to have an equal share of these in this year. So therefore, the expectation of our revenue and the profits of that would be quite stable in this year. It will be normalized, because in one of the cases where, let's say in the SAM case, the margins are lesser, while the others, the margins are better. And on the, like you said, on the Astra and thus, there are expected orders. We're looking at a substantial order book rise in this year. But like I said, on the average of the 3-year block, this 20,000 crores is likely to be sustained.
Right. Got that. Thank you very much for joining us. It's a pleasure. So 20-25% growth in revenues this year, margin closer to 20%, and another fresh 20,000 crores of orders in the next 2 to 3 years. That's essentially, the forward-looking guidance coming in from Bharat Dynamics. We'll go back to our 9-10 calls. Sudarshan and Mitesh are with us. Sudarshan, what do you have?
I buy Ashok Leyland with a stop under 210.
Ashok Leyland under 210. Mitesh, what about you?
I'll go with a long on Reliance for targets of 29.90.
Okay, Reliance with targets of 29.90, stocks at about 29.40 at this point in time. Well, let's revisit a couple of stocks, PI Industries and MGL. Sonal is standing by with an eye on those two. Sonal.
Well, let me start with Mahanagar Gas, because they had an analyst meet and they reiterated their volume growth targets for FY25 at 6 to 7%, which will be led by the industrial and commercial segment, where they could see a growth of around 11 to 13% in volumes. Now, EBITDA margin, that is likely to normalize to 9 to 11 rupees per unit versus 14 rupees per unit that they saw in FY24. This is because of 2 reasons. One, APM gas allocation that has come down for CGD companies, and second, spot LNG prices are higher, which will put pressure on margins points as well. Now, management is also watching out for gas coming under GST, and they expect a rate of around 12%. And if that does happen, it will benefit the entire value chain, including MGL as well. So that is a big trigger to watch out for the entire gas space as well. Now, the matter pertaining to marketing exclusivity, where PNGRB recently took back the notification on marketing exclusivity and common carrier, is still sub judice according to them, and 31st July is the date of hearing. So that will be the next trigger for all these city gas distribution companies as well. For PI Industries, well, there is a sentiment negative news because one of their biggest customers for pyroxosulfone, that is Kumai, they have lowered their guidance by 9% for FY24, and they also say that it is because of global destocking. Now remember, pyroxosulfone is largest export product for PI's CSM segment, so this could come in as a sentiment negative for the stock.
Right, we asked PI Industries about this one. They did say that it's actually up to our customers. So, I mean, this is coming in as an important cue. Sonal, thanks very much for that. So, PI and MGL in focus. CEAT is the other one we want to sort of also talk about. And I think there was an investor day. Vamakshi is here with details though here. Vamakshi, morning.
Well, good morning. Well, absolutely. When I look at the key takeaways from the con-call, they said that FY25 volume growth is likely to be in high single digits to low double digits. FY25 exports are expected to likely grow by double digits, and the key focus regions include Latin America, Europe, the US as well as Middle East. Medium-term target is to increase share of exports to 25% from 19% in FY24, and in fact they're targeting to become the number 2 player in the PCR segment by end FY25 from number 3 currently. Tyre realizations are also expected to improve on premiumization as well as electrifications, while the raw material costs are expected to rise by nearly 3 to 4% in the first quarter due to cost of natural rubber as well as crude derivatives. So given all of those factors, we have a couple of brokerage calls as well. Nomura has maintained a neutral call, target price of 2,820, and Investec on the other hand has a buy call, target price of 2,900 per share.
Okay, all right, got that. Vamakshi, thanks very much. And there goes the bell. So the starting is about 35 points higher, 23,333. Remember, 338 is the all-time high on the Nifty. And I think here we are. We have hit the all-time high. So yes, the Nifty joins its, cousin, the Sensex, in making fresh all-time highs. What's leading it? Actually, let's quickly pull up some of the major movers. Adani Ports, Power Grid, Adani Enterprises, Coal India, Bajaj Auto, BPCL. These are the early movers, NTPC, Wipro. So very mixed and a very diverse set of stocks taking the market higher. The Nifty is finding a little more traction, 23,375. So building on that, first opening gap up with the fresh all-time highs in the bag. On the downside, actually not too much. There's a bit of a cool-off in some IT names like Infosys and LTI Mindtree. There's Hindalco, which is down about 1%. But otherwise, the rest of the market's actually looking pretty good. It is. It's a century on the Nifty now, and we're closing in on 23,400, guys. So off to another solid start this week.
Well, some of those Mr. Chandrababu Naidu related stocks, so to call it, and he's back at the helm at Andhra Pradesh. They continue to run along. Heritage Foods, well, guess what? The stock was up 45% last week. It's up another 10% today. KCP, it's up close to around 10% as we speak. Amara Raja, another 9%. Keep in mind, these are stocks that have already seen a big rally, and they're just building on the gains out there. We had highlighted a few stocks in Friday's trading session as well. KCP is what we covered earlier in the week. Then we had told you that if in case, that entire Amravati plan needs to come back on the table, then there could be select stocks like NCL that could gain. You have Sagar Cements as well that's doing pretty okay. So some of these stocks that have seen a big rally, they continue to pile on the gains, and that's clearly evident on the screen. Well, just take a look at a few more names. Ashoka Buildcon, well, the stock is up close to 10%. So that's another big move in today's trading session. Paytm is up close to around 7%. BEL is up close to around 3%. So big moves out there. Suzlon's one of the top losers, actually. It's down close to around 3%. Vedanta's coming for selling. Prashant had highlighted earlier that silver has seen a bit of a pullback. And, that's the only play on silver. So when silver does well, some part of the valuation comes in from silver. So that's why, in fact, that stock has pulled back close to around 3%. And Emphasis down, but pulling back a little bit. Prashant.
Let's just pull up, Muthoot and Manappuram as well. Gold prices have sort of taken a bit of a knock, 3.5%, 4%. There are no sort of gold stocks in that sense here. There are gold finance companies. And they've done well when gold prices have risen. So we'll take a look at that as well. Nothing so far. It's absolutely flat Muthoot, but there are no volumes. I mean, 7,000 shares so far, and Manappuram as well. Manappuram is down about 0.16%, so nothing. The market's risen very, very fast to being up 100 points. So, if you're waiting for some consolidation and stuff, I mean, not happening, at least not this morning. It's triple-digit gains once again here as far as indices are concerned. But I think we should, at some point today, start to see a bit of a cool-off, a little bit of that much-awaited, slower pace of move, let me put it that way. Paytm is up it was up 10%, I think, on Friday. It's up another 7.5%. There is Patanjali, which is up 5%. Some of the big volume-led movers is what I'm referring to. Amara Raja batteries, that is up another 6.5%. Exide, of course, was all the talk of town for the last many weeks. But last few days, Amara Raja has started to pick up very sharply. And you've got Adani Power, which is up very sharply as well. So 810, it's up 6% on Adani Power at this stage. What else? There is Railtel, which is up 4%. Railtel is up 4%, 391, 392. KEC is up about 5.5%. KCP continues this massive move. From 180 kind of levels, 170 kind of levels, which is where it was on the election results day. It closed that day at 170. It's at 260 now. So that's KCP. I think Nigel has been highlighting this one as well with regards to the change in government in Andhra. There is GPIL, which is up about 6%. Jyoti CNC is limit up 10% on Jyoti CNC, and it's got large volumes as well. Exicom is up about 4.5%. You got a new listing, TBI Con, but it's got some prominent HNI investors. That's up 4%, 217. Was up 5% on Friday. I think it's up again. And so it goes. So it's a good-looking screen. Market breadth is 6:1 in favor of advances at this stage. So all in all, a pretty good open this Monday morning.
Absolutely.
Yeah.
Well, it's 400 par for what it's worth, 23,400 is astounding, this market, absolutely. The only thing is doesn't, stop to digest any gain at all. It's like, eating more on a daily basis without waiting for digestion to really kick in. But, that's the nature of this market. I just want to mention Motilal Oswal. The reason that stock's higher by about 14% is that there is a 3:1 bonus that's kicking in today. So that is the effective date, and that's why you're seeing so much of excitement around that stock. Paytm had a fantastic session on Friday. It's building on that this morning. Paytm is up another 8%. It's back to about 413 as of now. Ganesha Housing is up 8.5%. We're discussing a lot of these housing finance players that are getting excited because housing remains a very, very big focus area in Modi 2.0, expected to remain the same in Modi 3.0 as well. Heritage Foods up 10% circuit. Nigel's been spotting that stock for the last couple of days. Ashoka Buildcon 7% higher. So yeah, it is extremely buoyant. And the Nifty also retaining a bulk of its gains as well. Power Grid is the top gainer with a move of around 2.5%. So yeah, solid start to the week.
No, absolutely solid start for the week, and 23,384 is where the index is now holding at. Rana Gupta is with us at Manulife Investment Management. Rana, good to have you with us here. Good morning. Prashant this side. Thanks for joining in. So now, of course, all eyes on who gets what in terms of ministries, and I think we will get that pretty soon. But it is NDA 3.0, Modi 3.0. Let's talk about which are the sectors where you think the impetus. We will see impetus. Will it be this? Will it be once again a large infra-led push that we've seen for the last 5-6 years? That majority of the thrust will be, or do you think there is any indication that there'll be a little more attention on the consumption side as well, because both are relevant for them from a market perspective as well. Go on, Rana.
Oh, absolutely. Good morning. I think if you look at last 3 or 4 years, the fiscal consolidation has been really sharp, from 9% to about 5.1% in last 4 or 5 years. But within that consolidation, we have seen the capex, the infra push, capex to GDP has moved up from 2 to 3.4% of GDP. At the same time, the revenue expenditures have come down from 15% to about 11%. So as a result, what we have seen is that pretty strong GDP growth over the last 3 years, 7-8 percentage points or thereabouts, but led by infra and investments. Now, we do not think as a result of this election, there will be a U-turn of sorts, but we definitely think that there will be a much better balance going forward. while the revenue expenditure, while the capital expenditure can grow at 10 or 12% as over to 14-15% earlier, but the revenue expenditure has some room to go up from the current levels. In other words, I think we expect there will be some welfare measures that will make a comeback. And that is, again, not a U-turn, but a much needed balance that should come back. And that should come back in the areas of education, healthcare, and also through welfare infra linked, like, housing, so on and so forth.
Okay, got it. Mr. Gupta, what's your take on PSU stocks? I mean, have you participated in the rally over the last couple of months? And now, I mean, if yes, are you going to be taking some profits off? What's the stance?
See, the PSU stocks, if I just link it back to my answer to the earlier question, whereby, the government was largely, the growth was largely infra and capex led. So all the capex facing PSUs did extremely well. Now, some of these PSU stocks, whether it's defense or whether it's in construction, whether it's in capital goods, has gone to valuations of 30-35 times PE. Now, that is comparable with the private peers. And also, we are talking about companies where the owner and one of the major client is government. And we are also talking about somewhat better balancing of capex and revenue expenditures. So I think this industrial construction facing PSUs, which have done extremely well. And I think fundamentally the companies will continue to do very well. But it is just that now the P's are beginning to look very high. On the other hand, if you look at the state-owned companies in the areas of energy or power or even banking, there the stocks have done well, but the re-rating has not been this sharp. And our base case is, again, like I mentioned, repeat again, no U-turn, but better balance. Even a better balance will be good for the PSU companies in the large PSU banks or in the energy sector or even the utility sector. I think this is where we have seen some re-rating, but the valuation is not as high. So we continue to remain bullish on this segment of PSUs.
All right. Hi, Rana. Good morning and good to see you, Ben. Rana, what about the FMCG stocks? The monsoon year in India has already hit, which is great news. We want a good monsoon. And now most expectations are we'll have an above average monsoon, which will be good. In addition to that, you have a new government that could focus a little bit more on consumption than capex. Not entirely taking their leg off the pedal on capex,
yes,
but maybe some kind of focus out there, which could be good. And FMCG names, most of them are trading at pretty decent valuations. Your view on them, the likes of Lever, Dabur, Marico, they have suddenly come back to life.
Oh, absolutely. I think they have started coming back to life since the earning numbers came, right? And the earning numbers were a bit ahead of expectation. Guidance was a bit better, and these stocks jumped 10, 12, 15%. That just goes to show the under ownership that is there and how a small rebalancing the economy can trigger this move in this stock. We remain pretty much of the view that the FMCG stocks now, they will, their earning downgrades that was ongoing, that has now bottomed out. And going forward, the growth might even pick up. But, these are FMCG large companies. When I say growth pick up, it cannot be like a very high number. It can be 3 or 4%. But considering that you juxtapose that with the earning, the reasonable valuation of the companies, in the context of its own trading history, that's first. And the under ownership, I think FMCG stocks can be in for some good time.
Okay, so FMCG is a space that you like. What else, Mr. Gupta? What are your top favorites at this point in time in terms of themes?
See, we've referred so far coming into, let's say, even on 13th May when I was in channel, we were highlighting that we were thus far backing industrials as our top sector. But, there's some rebalancing required. So I think the sector that has underperformed, if you look at last 1 year, industrials, real estate, PSU as a fact, they are up between 80 to 100%. Whereas FMCG, private sector banks, they're up like 10 to 20%. Now that kind of performance disparity, I don't think will continue, especially in the context of the new regime, new government, and some orientation of expenditure towards consumption, not cutting capex, but some orientation towards consumption. In this kind of environment, I think the sector that has not done well consumption, private banks, they deserve a look. While at the same time, we are not suggesting that industrials will suffer. But I think what I'm really suggesting is that the industrials, the real estate, the PSU, as a sector, that done very well. But going forward, one needs to be far more selective in that.
Okay, all right. Rana, what about the metal space? You know, some of these metal-related names are doing very, very well. You know, just to highlight a few of them, you have Infra, that's Indian Metals and Ferroalloys. You know, that stock is flying away. It's up close to 6%. We had highlighted this last week as well. A few of these politically related names, which have a good fundamental business as well. So I think Indian Metals and Ferroalloys should come up for you. We have Nama Limited as well, another one that's moving up. These are smaller names, but just highlighting because they've moved up. How do you approach some of these metal stocks? Ferrous versus non-ferrous. The optimism is around China recovering, which may or may not happen. But how do you approach these stocks?
So first of all, we look at largely the stocks which are pretty sizable and largish cap rather than, you know, the micro and mid caps which are even could be somewhat politically connected. So we look at the top tier companies in the metal space, just to be clear. Now within that, I think the steel market has undergone transformation. I think not just in India but globally. There has been minimum import price that has been implemented, which protects the domestic steel companies to a certain extent. Having said that, I think the steel companies also have done quite well. So I think for steel companies, the risk reward looks balanced from here. On the other hand, if you look at the non-ferrous space, and in non-ferrous space, there is this one company which has a large downstream operation also. We like that because where there the earnings are far more predictable, the business is growing, they're putting their cash back into further expanding capacities, the valuations are very reasonable. So we continue to like very specific non-ferrous companies.
Which one? You were going to give us the name, I think so.
Unfortunately, I cannot give you the name of the company, but
okay.
This is one of the largest non-ferrous company with a downstream operation. So,
with the promoter who's a little bit tricky?
No. We stay away from promoters where promoters are tricky.
All right,
okay.
Nice one.
Then it's the one. It's the one that has some operations in the United States as well, right? Which was looking at the IPO.
They have operations worldwide.
My God, I mean,
Nicely asked and nicely
this has to be
indulged.
It has to be indulged.
All right, we'll leave it there. Rana, thank you very much for joining us. It's a pleasure and good speaking with you here on CNBC-TV18. So that is basically metals and mining in focus towards the end of that conversation, and a view on the market as well. Well, post the swearing-in ceremony of Prime Minister Modi and, of course, the other ministers, CNBC-TV18 Sririn caught up with experts in the market, Sunil Singhania, Atul Suri, about what to expect under sort of Modi 3.0. These are some of those comments. Listen.
Retail investors in India are making wealth out of the growth of India, which is a great sign. However, you know, I think what has happened, obviously, as Atul mentioned, that Monday, you know, actually just changed the complete perspective, and you had like a crazy move up. And maybe, you know, what has happened over the week is a culmination of the disappointment of Tuesday. We are very confident that the third 5-year term would be a very transformative term in terms of GDP numbers actually coming out much better than what we are expecting. Already, you know, we saw the March quarter numbers of 8.2% as far as the GDP is concerned. And I think that is very clearly reflected even in the stance of the foreign investors. Very sure they are also looking at opportunities to come in, which we already have started to see towards the end of last week. And that trend should also continue. And I think this is one space where India has huge, I would say, you know, room to cover. And the other good thing is that we have a lot of, you know, global institutions more than willing to you know, support this by way of investments. So I think this is going to be a key focus area, you know, whether it's roads, railways, all kinds of infrastructure, ports, airports, and, you know, water. And you mentioned earlier about the rural thrust. I think a big thrust for rural will also be development of all these basic facilities for people in general.
Very, very important. Things may change, priorities may change a little bit on the social side, but as far as the markets go, as far as the whole, you know, thrust to industrialization, liberalization, the thrust to the next, you know, decade or the Amrit Kal, whatever, you find that the push would continue. And I think the markets would reward it. And apart from just India, Shireen, the important part is that even globally, things are pretty good. They're shaping up. The ECB has cut rates. So all in all, we are in a good environment. I do think that we would continue the up move. Yes, there must be a little shuffling around in the sectors and themes that may happen. But then after such a big an event, a little bit of rotation goes for the par. There's a sense that there is going to be much more rural push. And that's why you'll find that certain sectors that did very well in the last 2 or 3 days. First is autos. Autos really stand out because I think personally that sector was up 6 to 7%, if I'm not mistaken, for the week that went by. And there also you'll find that those auto stocks which have a rural bias did very well. A lot of them touched lifetime highs, even in this falling market. The second area that did very well was the whole consumption, the FMCG space. Again, a sector that's been a bit on the quieter side for the last few months, but there is a feel that rural consumption would spike up. IT, again, the third sector that's done well. And what would come under question is the runaway in some of the defense and railway stocks. Again, I don't think the trend is over. The trend is very large. I feel the bigger trend is still up. I still think there's a lot of opportunity and money to be made.
All right, that was market opinion that we got, Shireen, in conversation with the market veterans there yesterday while we had our live coverage of the swearing-in ceremony. By the way, we should be expecting more action on this. Prime Minister Modi is expected to reach South Block and take charge for the third time as the Prime Minister of the country. So I think 10:30 onwards, most of these things will start flowing in. And then, of course, there'll be chatter about the portfolio allocation. But we'll wait by for that. For the time being, let's focus on another business, another company. Chalet Hotels is on our radar. Now, the fourth quarter was a pretty decent one for the company. Occupancies increased and profits were expanding. We have with us Mr. Sanjay Sethi, MD and CEO of Chalet Hotels, to take a couple of questions to talk about the order book. Mr. Sethi, thanks very much for joining in. I'm just reiterating the numbers for the benefit of our viewers. Now, fourth quarter, your top line was up almost 24%. Margin came under a little bit of pressure, coming to about 43.7, but profits expanded very handsomely, 125% up on profits. And I believe your occupancies were at 76%. So, sir, tell us now that we are in the first quarter of this year, what's the expectation? And do you think the kind of bumper levels we saw in occupancy towards the end of last year, whether that can continue? Where are occupancies right now? And what's your anticipation from this year?
Good morning. Pleasure being back. I'm not going to be able to share any operating numbers for this quarter because it's price-sensitive information. Generally, from the reports that I've seen from consultants, we have seen a slight slowdown in ADRs in some leisure markets in India. But the business city hotels continue to do very well in the month of April. In my view, the May numbers haven't come, but I do believe May would have seen some sort of headwinds on occupancies due to the election and the heat. And we believe that should sort of normalize through June into July. So that's a quick overview.
Okay. All right. Hi, good morning, Mr. Sethi, and thanks a lot for joining in. Well, you're saying so some headwinds were experienced in the last 1 to 1.5 months or thereabouts. But we don't want a near-term guidance. As you said, price-sensitive information is not something that we want to know. But we want to know what is the guidance, what's the aspiration for the year, both on occupancies as well as on the average room rates. I think in the past you've hinted that it should grow by double-digit for this year itself. So could you revise those numbers for us?
Good morning again. And, I believe that we're going to hit about low to mid double-digit growths in our business or our revenues as a whole. And with some new additions coming in, that should go further northwards. Occupancy, I think, has headroom to grow by another 300 to 400 bips. And at that point of time, it should stabilize around the 80% mark. So most of the growth is likely to therefore come from average room rates. Some amount of growth coming from increase in food and beverage. But I think room rates going to drive the business for hotels in the country. From a chalet perspective, besides all of what I said earlier, what's going to help us is the occupancies building up in the offices that we have. And we see that speeding up fairly rapidly. from this year onwards.
Mr. Sethi, just hold that thought. I just want to make a quick reference to the market, which is sold off sharply. The Nifty intraday will come up on your screen. And finally, that bit of quietening down of things starting to take shape. And there you go. I mean, we were up a euphoric 100 points. And I was saying that at some point in the day, you'll have that. And it's coming through now. But don't expect anything big. It's just that, you can't have 2% days every day. That's the only thing. And the high, by the way, was 23,408 or around about there. Yeah, 23,409 or so. And we're at about 23,300 roughly. So about a 100-point sell-off, a little over a 100-point sell-off from the day's high. In terms of what's putting the maximum pressure, Infosys is adding about 22 index points pressure on the Nifty. There is HDFC Bank. I mean, it's not as if HDFC Bank did anything great on the upside, but it's putting pressure on the downside. 21 index points coming in from HDFC Bank. There is TCS, ITC, HCL Tech, Tech Mahindra. So IT, which had a big week, the index was up 8% Friday to Friday. I mean, that is seeing some money being taken off. So that's essentially the state of affairs for the market, absolutely flat. We're also, by the way, now waiting to hear from Delhi in terms of the portfolio allocation, in terms of ministry allocation, cabinet berths and who gets what, etc. That should also be out over the next couple of hours. So we'll sort of, I think markets are also waiting for that. In any case, I think what's happening right now, here and now in the market's got nothing to do with that. It's just a little bit of cooling off from the highs. Another very euphoric start that we had earlier today, guys.
Okay, all right. That's the market. It is selling off, at least for the time being. Back to the conversation with Mr. Sethi. Mr. Sethi, I'm sorry, I missed, you mentioned that occupancies can perhaps go all the way up to 80%. I missed your guidance on the average room rates. You were, I think, at around 11,862. Without getting too specific into, point-by-point numbers, in general, what's the scope of improvement this year on ARRs, or will they be stabilizing at these levels in best case? I mean, you did say that the bulk of the growth will come from room pricing. So some sense on what kind of growth?
I'm not in a position to share percentage growths or numbers, purely because that will be, again, information that is not available to the rest of the market. But as I said, we are expecting somewhere between around mid-teen growth for the year, overall revenue basis. The occupancy growth will come, in a small way because the headroom is lower. But we do expect it to grow from 76 to somewhere around 79-80% occupancy. The balance growth will have to come out of rate growths.
Got that. I believe your target is to add about 3,090 keys, Mangalam tells us, in the current year. Is you on track to that? Could it be more or less? And what about the funding program? I mean, do you need to raise any money? Just give us an update on the balance sheet side as well.
Look, two things. Number one, we are not looking at adding 3,000 keys this year. We have 3,050 keys as of now. We have roughly around 900 keys under development, which will come into play in the next couple of years or so. We are keen to look at other opportunities on the development side. And if we get some opportunities, we'll certainly build more. Our balance sheet has been healthy and has got healthier. We did a QIP of 1,000 crores. That's brought our debt down to somewhere around 1,400 crores and change. And is extremely sustainable and low debt, actually, which gives us headroom to grow. And we'll use those opportunities as and when they come.
Okay, all right. Mr. Sethi, I wanted to ask you about a couple of new projects that you're working on. West in Hyderabad, and the other one, and that's one of my favorites, the Kandala property, Dukes. As a kid, I recall when my parents said that we're going for a vacation, Nigel, to Dukes. It was something that we really looked forward as children. I drove past actually over the weekend, and I could see construction in full swing over there. So when do both these two start reflecting in terms of revenues?
Thanks, Nigel. Yeah, Dukes is a stunning property, stunning views. I think it needed a serious push up in terms of quality of product and services. And that's what we're doing right now. We expect to get Dukes fully operational by end of the calendar year. But it should be operational in parts in about a couple of months from now. The second one that you spoke about was Western Hyderabad. That was actually commissioned. That was the second hotel, which was commissioned in June last year.
Okay. All right, Mr. Sethi, thank you very much for that. Wish you good luck with the business rest of the year. So, Nigel, I guess maybe he's a couple of months on Duke. So maybe by the time the monsoon ends, maybe you'll manage one quick trip.
Actually, I went for a drive to Lonavala last weekend because I said in the coming weekend it's going to be packed.
Impossible.
It's going to be impossible. And on the
Actually,
way back,
best time to visit is now, right? I mean, now when the rain starts.
Right.
I'm guessing next weekend onwards, it's all
jammed.
gone.
I went really early in the morning. I could see on the other side it was jammed, so I was happy I managed to get there and get back as well. But that's about, that Lonavala property of, Shali Hotels. But let's talk about toll, because you're going to be traveling anywhere. Then that's going to be the other focus point. And IRB Infra, they reported a spike in toll collections in May. The company's toll collections in May rose by around 30% to around 530 crores. To discuss more on this, on the collections and business outlook as well, we're joined by Anil Yadav, Director Investor Relations at IRB Infra. Hi, Mr. Yadav, good morning and thanks a lot for joining in. Well, could you tell us what led to this sort of a strong toll collection in the past month? And what was the contribution of TOT projects, 12 as well as 13?
Yes, thank you. Thanks for the opportunity. We have seen a robust growth in the toll collection, almost 30% growth in the toll collection as compared to the same month of the last year. And this was contributed by traffic growth and addition of the new project. And if you look at the TOT 12 and TOT 13, both the projects we have started from 1st of April, and collection is better than what we have projected for these two projects. So now all the projects have already started generating their revenue, except one. All the projects are already operational.
Okay. Mr. Yadav, can you give us some guidance for this year as a whole? What is the, what's the increase in collections that you are projecting?
So I think this year as a whole, both IRB and private InvIT put together, overall growth in toll collection should be in range of 20 to 25% for full financial year.
20 to 25% for the entire year. Okay, within that, if you could just talk about one marquee project, which is the Hyderabad Outer Ring Road. It's a massive project. What are the trends over there?
Yeah, trends are in line with our projections, and growth is also good. And this project is, we are doing good on the project. And in terms of the traffic growth is also good.
Okay, that's on the Hyderabad Outer Ring Road. Beautiful, of course, infrastructure development over there. Mr. Yadav, there's been a lot of chatter about what the pace of ordering activity is going to be from NHAI. Last year was a bit subdued and then we were getting into elections. What did you notice during this just this pre-election phase? Did the ordering activity go down substantially? And what is your expectation now?
In fact, in spite of the very low ordering activity last year, we have bagged in last 1.5 years, we have bagged a project worth of more than 200 billion, that is more than 20,000 crores. And that was as against 4,000 to 5,000 crores of our usual run rate. And that was a very good year for us. Last year was a very good year for us. And there is almost 2 trillion worth of opportunity lined up in BOT space. And those will be coming for the bidding very recently. And there we will be participating in the bid. Apart from the 2 trillion of BOT opportunity, there is even TOT opportunity. More than 35-40 projects are already, list is already out on the NHAI website. And those projects will also come for the bidding in the near future.
And which of these categories makes better commercial sense for you right now, BOT or TOT? What's your own focus going to be this year?
Yeah, so in fact, the company has preference in terms of BOT, TOT and HAM. In a BOT project, the execution is also done by the 100% subsidiary of the listed company. And as far as equity requirement, this BOT and TOT project gets executed through a private InvIT where IRB and GIC is 51-49% partner. And our equity requirement gets reduced to 15%. So BOT is the most first preferred kind of project and followed by the TOT.
All right, Mr. Yadav, besides the operational performance, there was some small stake sale by the promoter entity. Could you tell us what is the updated shareholding, in the sense, what is the promoter holding come down to? Why did they sell that? And will they look to sell more?
No, I don't think so. They are going to sell any more shares. And this was the first sale since the listing of the company. And promoter were acquiring the stakes in the company, whatever the dividend we have distributed. And their stake was 34% prior to the sale. And they sold close to 4% to create the personal liquidity. And post this transaction, promoter will continue to hold 30.34% in the company and will remain the largest shareholder in the company. The promoter is remain committed to steering the IRB's business going forward as well.
Okay, that's an important clarification. So no further stake sale in the foreseeable future, right?
Yes.
Okay. So just a quick final word on the business, Mr. Yadav. You were talking about this large, awarding pipeline that you see here, maybe 2 lakh crores on the BOT side, as you say. What about the intensity, the competitive intensity in terms of bids? How is pricing and how is the marketplace with respect to bidding?
So I think in terms of the competitive intensity, if you look at the cash contract where your skin in the game is very low, or even for that matter, HAM project where the equity requirement or your capital requirement is very low, there the competition is pretty high and almost 25 to 30 players submits the bid. Now, in terms of the TOT and BOT, it's largely some few players, and plus the funds are bidding for this project. And typically what we have seen in the past, around 3 to 4 players are submitting the financial bid. There the bidding intensity is lower as compared to the HAM and the EPC project.
Okay. Final question, Mr. Yadav. What is your exposure, if you have any, to Hyderabad, to Andhra Pradesh specifically, and to Bihar? Just tell us about your current exposure and if you would expect a heightened bidding activity in these 2 states.
As far as IRB is concerned, we don't have exposure to these 2 states. And typically we bid for the BOT, TOT and HAM. Typically we don't bid for the EPC project. And going forward also, we don't have an intent to bid for the EPC project. Today we are collecting money, that is the toll collection, from more than 1.5 million users on a daily basis. We are, that is our basically retail kind of network what we have created. We are collecting money from 1.5 million users on a daily basis in terms of the toll collection.
All right, Mr. Yadav, we leave it there. Thank you very much for that conversation. Appreciate you joining in with some of the detail there. We'll slip into a quick commercial break here. The market's basically flattened out, absolutely flattened out. From being up 100 plus points, we're just up about 5 or 6 points. We'll take a quick commercial break here and we'll talk politics. And Mr. A.K. Bhattacharya, senior journalist, and Sanjeev Srivastava will be joining in with the new government formation as Mr. Modi takes on as Prime Minister for the 3rd time. All eyes, of course, on portfolio allocation, etc. Shouldn't be long now. Stay tuned, that's coming up.
Or that's what the street believes as well. So the last year they did around 11 rupees, but the next couple of years the street believes that it's going to go to 22 rupees. So they believe there's going to be an improvement on ground. Looking at the valuations, even after this 50% move that we saw in this week itself, well, it trades at close to around 31 times. The 5-year average is around 29 times. So in that context, it's not very, very expensive. What is the street factoring in? How come the EPS goes up by so and so? They are expecting the value-added products, that was around 30%, to scale up to high 30%. How is that possible? Well, they have been mentioning this, in their con calls as well as in the presentation that they put out. Also, they had some high cost inventory of, SMP. And out there as well.
Okay, welcome back. The market's down about 23 points, so there is a bit more in terms of selling pressure, which is starting to come through. Prime Minister Modi and 71 ministers took oath as the NDA government was sworn in for the third time. The new cabinet has 30 ministers, including 5 berths for key NDA allies. Portfolio allocation, however, is still awaited. We have, those are visuals, of course, coming in from yesterday, which was very, very keenly followed. Mr. A.K. Bhattacharya is with us, Editorial Director, Business Standard. We also have senior journalist Sanjeev Srivastava joining in. Gentlemen, good morning. Thank you very much for coming back on here on CNBC. Prashant this side. Mr. Bhattacharya, from a portfolio allocation perspective, which are the berths or the sort of postings which matter from a market point of view? Finance one. What else?
Well, all the infrastructure ministries are very important and critical. And the industry and commerce are also very important ministries that will be looked at closely. Of course, finance ministry will be the most keenly watched. But I don't expect many changes at this point in time. You have all the ministers who had manned, or if I may use the word, who had steered these infrastructure, commerce industry, and the key finance ministries are all there in the cabinet. These have all taken oath. Unless there is a major reshuffle of ministries among these candidates, I don't see any major surprise in terms of the ministry formation. You have got Nirmala Sitharaman in the cabinet, you have got Piyush Goyal in the cabinet, you have got Ashwini Vaishnav in the cabinet. You have got Dharmendra Pradhan in the cabinet. You have got Nitin Gadkari in the cabinet. So they're all critical ministers who had taken charge of the economy in the previous government. What will be keenly watched is whether some of these key economic ministries where next stage of reforms will require states' involvement, go to ministers who come from the coalition partners. One of the key problems that the previous government faced was how, in respect of implementing reforms that involved the states. For example, there's a major reforms task that this government has on the third tier governance reform. Now, if you have a minister in charge who is coming from one of the coalition partners, I would imagine that task would be easier. Labor ministry is an important ministry wherein you have to notify the 4 labor codes which Parliament had approved, but they are yet to be notified.
Right.
With the states on board. So there are some critical issues which will await the actual allocation of ministries to these ministers.
You don't, Mr. Bhattacharya, basically you're saying there'll be continuity. You were expecting continuity, right? Not very much in terms of even
because there are no surprises. There are no surprises in the inclusion of ministers who are already part of the previous ministry.
Got that, Mr. Srivastava. Your sort of thoughts on the same. Are you expecting sort of any changes? And you know, for the last 10 years, I mean, ministers, of course, have been important, but overwhelmingly, the big focus has been on what Mr. Modi can do, right? The question always was what not A or B or C minister will do for a particular sector, but what Mr. Modi's vision is as Prime Minister for whatever sector. Do you think, I mean, you know, you're going to look at things like that, or individual sort of ministership, etc., becomes very important in that sense? Your thoughts?
So you're absolutely right, Prashant, that everything was driven largely either from the PMO or from the Home Minister's office. So even like agencies, ED and income tax, which come under finance ministry, were largely being seen as controlled by the Home Ministry. So in the list of important ministries, which AKB just mentioned, I would also add Home. Whether there'll be continuity there, most probably there will be. See, one big point which I think needs to be underscored at this time is while it's all seems business as usual, continuity, waters appear very calm, the ship looks very stable. After all, 240 is a very good number. You remember UPA 1 and 2 were run by much lesser numbers. But what I see and discern is this pattern or this approach of either the BJP spokespersons or the leadership or the entire ecosystem of media, that this will be a government just similar to what last 10 years was. And I think therein lies, in that attitude lies the problem. It cannot be business as usual. The government needs to adjust and settle down with the new reality. So even if the allies are not demanding much, it is a coalition government with a strong, very strong center with 240. But the attitude should be that it is a coalition government and Prime Minister is the main steering force. He is the first amongst equals. But the first amongst equals bit also needs to be emphasized a little more than it was during the last 10 years. So I think that's something which is very important.
Absolutely, Mr. Srivastava. I think the narrative more in the market and business arena is economic policy continuity. Politically, of course, things will have to be different. Perhaps it will require a slightly different approach in terms of just, politically how things will be handled and how equations are going to be handled. And that's a no-brainer, right?
The two. The two cannot be segregated so simply.
Perhaps, and which is why my next question.
Yeah.
So, which is why my next question, allow me to ask that question. That's what I was just coming to, and I want to get both of your thoughts on this. So let's take a ministry like railways, right? And it's been the poster child. We've seen what's happened to railway stocks. There's been incredible spending, a lot of fundamental ground level changes as well in terms of, the execution part, the way railway PSUs are run. Now, what if one of the allies asks for railways? What if, Mr. Nitish Kumar demands that? A, do you expect that to happen? And B, even if one of the allies takes away important ministries, contrary to what Mr. Bhattacharya is saying, if the allies decide to take away some of these critical ministries, infrastructure or railways, then what happens? How should that be interpreted? Mr. Srivastava?
See, I don't think it is who will be having the ministry which is more important. Even if the allies don't get an infrastructure ministry or the railways ministry, the important thing is the approach. So last time I remember Prashant talking about an AKB raising the issue of welfareism. And I was saying that welfareism is not the takeaway from this election. But I am entitled to revise my thoughts. Like certain schemes, like I was talking to people, like with keeping in mind the Haryana election, the Agniveer scheme may be tinkered with or rolled back. That would have financial implications. Similarly, a BJP minister can continue to have all the infrastructure and finance ministry and railway ministry, but they will have to take on board the views of the allies, especially TDP and JDU. So it has to be, the approach has to be one of consensus and taking everybody along, which is where this government needs to walk the talk depending on what the ground situation and the arithmetical reality in the parliament is. That's
Mr. Bhattacharya, sure. Mr. Bhattacharya, if you could come in on that, sir. I mean, even if, let's say, what Mr. Srivastava is saying, even if the minister continues to be a BJP candidate in some of these key ministries, will the allies still have a much greater hold, a greater sway and say in areas like finance, in corporate affairs, in railways and infrastructure?
Well, I broadly agree with what Mr. Srivastava has articulated right now, but I would like to add and maybe modify the proposition that you put forward, that I don't entirely agree that it will be the continuity that will be watched closely. Because if continuity were to be the main yardstick of judging the new government, I would say both the markets as well as the nation and the citizens and the voters would be a little disappointed because it's important to note that in terms of key reforms or the key important steps that will bring about greater efficiency in the economic system, the last 5 years have not seen any except Air India. There was no other privatization. So when you say about continuity, are you talking about no privatization in the next 5 years? Now that will be a disappointment. There has been no movement on the labor reforms front. Now, would you be happy with this continuation of no further reform on labor front? There has been no further movement on the well thought through farm sector reforms. Now, I think the idea is not to only see that whether the government is of continuity, but whether the government takes the necessary political risks or use its existing political capital to bring about the much needed reforms in key areas as what I mentioned. So I think it's important to have ministers who are in charge of key economic and infrastructure ministries, but at the same time, those ministers should be empowered. And if that empowerment means that the railway ministry goes to an alliance partner, so be it. So I think it's very important that continuity of the kind that we saw in the last 5 years is not continued, so to say, and we see more reforms in these areas. I mean, there is a policy of the previous government that non-strategic PSUs will be privatized. There is a policy of asset monetization. Now, the question is, if we are happy with continuity, then I see an area of concern that continuity would mean no privatization, no further push to asset monetization, no labor law reforms, no farm sector reforms. So I think that is very, very important to keep in mind.
That's well put, Mr. Bhattacharya. Now, but by the way, we were talking about this welfareism. I was looking at the CSDS Lokniti data. BJP's vote share among the poor actually has gone up. So, and this kind of goes back to some of the points we were talking about earlier about, whether there'll be a change in stance or, and whether there'll be more sort of helping the masses and stuff like that. I mean, the data shows otherwise. Anyway, Mr. Bhattacharya, just, without tackling some of these more contentious issues, are there specific areas, do you think, where we can see a thrust from the government? Could housing be it? Is there one or two areas that you would like to identify whether it's possible? Yeah.
Taking off from what you just now mentioned about the CSDS survey, I think there would be a more refined approach to welfareism in the sense that if you believe, and I do believe, that this government is fiscally prudent, in the sense that it has not really used its resources. It has used its resources in a manner that the fisc has, by and large, has been kept safe, although the overall target and trajectory has not yet been met. Now, so therefore, there would be some refinement in the welfare schemes by which a better targeting with the use of technology in the delivery system through the digital public infrastructure, that is possible. Mr. Srivastava talked about tweaking the Agniveer scheme so that the big shock that the BJP probably received in the way the Agniveer scheme was received in states in like Haryana, states like Himachal Pradesh, which produces a lot of these soldiers, and
Rajasthan.
Rajasthan also. So I think it's possible that the Agniveer scheme may be tweaked, but I would hope that all those welfare schemes that are tweaked and made more focused do not bleed the fisc, because please remember that while fiscal consolidation has to be the primary task, it is also equally important how you use the extra money that the government has received from the Reserve Bank of India, which is almost as large as 0.37% of GDP, should be used more efficiently, effectively, and bringing about faster growth, creating more jobs, and ensuring that the kind of iniquitous growth that we have seen with the top half of the economy doing well faster than the bottom half, those issues are addressed.
Yeah, absolutely. Gentlemen, Valid point, and I think that additional cushion of 1 lakh crore rupees from the Reserve Bank of India, that would be very, very timely. And it'll be very interesting to see how the government puts it to use, and we'll have those answers come the budget. Thank you for joining in. Of course, we'll keep coming back to you. Hope to have more of these conversations as we know.
Once we have the portfolio allocations, Mr. Bhattacharya and Mr. Srivastava, I hope to have both of you back. And you know, we're expecting that any time now. So hopefully, you know, we'll be able to speak with you and get your reactions once we have that. Thank you for joining in. I think the market, by the way, is sort of be absolutely flat. Nothing. 3 or 4 point change. 23,300. Let's get Mitesh in for a quick word. Mitesh, what are your observations on the price action? The big sell-off from the day's high.
So I think, Prashant, you know, looking at the hourly chart, we failed to actually get past 23,307, which was the last time, you know, we had been here. I think after this big rally from 21,800 hitting the earlier high, just taking some profit booking, I'm not really worried. Would be a buy on declines. Let's say if you get it closer to about 23,150 on the spot, which is 140 points lower, then try and add on to long positions. Having said that, on the stock side as well, have a buy on ACC. That's doing very well. So ACC, I would recommend taking long positions, keep a stop below levels of 2518, 2517, and target of 2630, 2635 on the upside is what I'm looking at the minimum. Eventually, we may even look at higher levels from there. And the second stock, which I like, that's also a buy call, a buy on Britannia. It's a conditional buy. Consolidating for last 4 or 5 days. Once it starts getting past 54.75, 54.80 zone, buy with a 40-50 point kind of a stop and look for a target of 56.
All right, Mitesh, good speaking with you, and thank you very much for sharing those ideas with our viewers as well. Appreciate it. Well, you know, we'll just take a quick commercial break here. We put the focus on commodities. Precious metals have sold off, but is that top of mind for Manisha? We'll find out in just a bit from now.
That in fact, you know, that high cost inventory will be out of the way. And if you just look at the margins, well, they've come down drastically to around 5% in comparison to around 11% odd. So both of those are the triggers that are going to be working for it. And that's why the margins are expected to improve from here. And that's why the EPS as well is expected to move from here. Well, next up, let's move to Amara Raja. You know, you have Mr. Gala, who was a TDP member. He was also a member of parliament from Guntur. This time around, he wasn't, standing for elections from out there. But in fact, there is that bit of the TDP play, so to call it, for Amara Raja. Besides that, you know, besides the core business, they're also talking about cell manufacturing facilities. And the cell manufacturing facility, well, that's something that is likely to come on stream in the second half of FY26. The capex that they've laid out is close to around 1,200 crores. They're talking about an asset turn of around 1.3 to around 1.4 times odd. So that's going to be the key trigger fundamentally that we're looking forward to. In terms of valuations, the stock has gone up big time, but it still trades at around this, 24, 22 times odd. So that's on the valuation chart. Moving to the cement and the infra themes then. The street believes that Mr. Naidu is pro-development. And because he's pro-development, cement will do well, construction as well will do well. So there is that pro-development agenda that's likely to come. And remember, when he was last in the hot seat as a CM, Amravati, that was the capex plan that the street was looking forward to. But when he lost the elections, well, then that complete plan went out of the window. So they're hoping this time around as well, the Amravati big capex plan will come on stream again. And because of that, you've seen stocks like KCP, you have Ramco, Sagar Cement, all of them, well, that's their capacity that they have in Andhra Pradesh as well as Telangana. And that's the percentage of their total capacity. So as you can see at the bottom of your screen, these three companies, in fact, 80 to 100% of their capacities are in this region. So they could stand to gain. The other couple of names, NCCA and KNR Constructions, both of them saw a big rally this week. A lot of factors out there, but just to highlight three factors. One is that Amravati capex plan that we're talking about. There are also some pending dues that didn't.
Welcome back. All right, let's quickly get back to Manisha and figure out what the top commodity cues are. Manisha, so what's top of mind for you?
Oh, well, all the metals actually will be, because we have started the month of June with a bit of a decline here. April and May saw strong gains, but we seem to be looking at a halt in the rally right now in many of these commodities. The latest trigger clearly has been the US non-farm payroll data, the highest in 5 months, and more than 200,000 jobs there. Markets were anticipating something like 160 to 190,000 there. So that clearly has been one of the reasons. And with that, the possibility of a Fed rate cut in September now has declined from a 68% in the previous week to 55%. And that one rate cut perhaps could happen in the month of November is what the most bets are suggesting. So I'll start with the gold prices, which have now broken below $2,300 an ounce. The all-time high has been $2,450. The month of June actually until now has been on a declining spree, and we are trading at a one-month lows when it comes to the gold prices there. Also, markets have seen China demand in sense of central banks see a pause in the month of May. China Central Bank has been buying gold for its reserves for 18 months, and that did not happen in the month of May. That has also led to a bit of a profit taking there. Silver as well fell 4.5% in the previous week. We're looking at a one-month lows onto this one. Not just that, the crude oil prices also have declined 2% in the previous week, and third week of losses is what we've seen onto this one as well. Copper, for that example, also fell 4.5% in the previous week, and this is after 10% gains in the month of May. Here as well, we are way off all-kind highs that we saw in case of copper there. Take a look at the steel rebar prices, and we are trading at around 2-month lows onto this one. 34.50 Chinese yuan per ton is where the steel prices are right now. There is weak demand in China. The home sales for the last couple of months have been declining as well. What the street will watch out for now is the Fed rate policy. Well, that announcement comes in on Wednesday, and so does the consumer price index numbers as well. So Wednesday is going to be quite important in sense of dollar and movement for many of these commodities.
All right, Manisha, thanks very much for that. That's Commodities in Focus. More with Manisha as we go on. We'll take a break. Our special segment, it's the economy. My colleague Lata will get chatting with Santanu Sengupta, Chief India Economist, Goldman Sachs, to put the focus on the RBI decision to maintain status quo, repo rates, and, of course, RBI's growth forecasts, which now are up. Stay tuned.
It believes this time around they'll get cleared out, so pending dues will get cleared out. And besides that, you have the fresh orders that could come about. So you have Heritage Foods, where he is the promoter entity. Amara Raja, there's a bit of a TDP connect out there, and there's a fundamental reason as well. And cement, as well as infra companies, they could stand to gain. Undoubtedly, the MVP of the last week was Mr. Chandrababu Naidu.
Looking ahead, the Reserve Bank will continue to be nimble and flexible in its liquidity management through main and fine-tuning operations in both repo and reverse repo. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner which preserves financial stability. The GDP growth that we are now projecting for the current financial year 2024-25 is 7.2%, with Q1 at 7.3%, Q2 at 7.2%, Q3 at 7.3%, and Q4 at 7.2%. The risks are evenly balanced. Private consumption, the mainstay of aggregate demand, is recovering. And it is recovering with steady discretionary.
Welcome back. The Reserve Bank left interest rates unchanged and gave no hint at all about the timing of a rate cut. The fact that it has upped the growth forecast may mean that rate cut is not needed because growth is strong. More important, however, Reserve Bank said in the press conference that it will release its view of the neutral rate in the next bulletin, RBI bulletin. Now, what's the neutral rate? It is the ideal difference between the nominal interest rate and inflation. With the current repo rate, that is the nominal rate, at 6.5%, and CPI forecast for this year at 4.5%, the real rate difference is 200 basis points. But if the RBI thinks that the neutral rate is 150 basis points, then the market will expect a rate cut sooner. So the next RBI bulletin actually becomes more important than even the MPC. For these and other issues, I'm joined by Shantanu Sengupta, Chief India Economist at Goldman Sachs. Shantanu, good morning, and thank you very much for joining us. I just had to give the preface because neutral rate is not something we, speak about very often. But what's your best guess of the cut? Are you on mute?
Sorry, thanks, Lata. So we think that the neutral, in our view, is somewhere around 6% for India, and therefore the real neutral is about 150 basis points. This is higher than what you've seen in the past in the region of 80 to 100. And therefore, we think that you can still have the quantum of cuts in India will be determined by the neutral rate, and which we think still is going to be only 50 basis points. The timing of the rate cut by the RBI still remains a difficult question, as one, growth remains strong, and along with sticky trajectory of food inflation might mean that some of the RBI MPC members may be reluctant to pivot immediately. But our call still remains that you go in Q4 of calendar year this year. It's a toss-up between the October or the December meeting, in our view. We think it's slightly more leaning towards the December meeting if you see that food inflation is sort of contained by then, and core inflation sequential momentum is also not as strong in the second half as you head into the end of the year.
Okay. I'll come back to the rates position and the fiscal connection in just a minute. But the other big takeaway from Reserve Bank was the increase in the GDP forecast for the current year, or GDP estimate for the current year. You already upped it by 20 basis points, your forecast, after what you heard from the Reserve Bank, or because the government is not what we thought it would be on 31st when you were making your forecast. It's a less, it's a lesser majority than we thought. Do you want to tinker your growth forecast either ways, or is there upward or downward risk to it?
So we are at 6.8% growth for the fiscal year 25. The calendar year is slightly higher, and basically the fiscal year is low because of the very high number that you got in the previous quarter. Look, for the cyclical growth view, we think the risks are fairly balanced. So I don't really think there's a major upside risk to our growth forecast, especially given the fact that we are still baking in the fiscal consolidation. Even after the election outcome, we think that we are still going to go towards 5.1% of GDP, or they'll try to slightly better that, maybe at 5% of GDP in terms of the fiscal consolidation. And then if monetary policy also remains tight, in our view, at least until October or December of this year, then and monetary policy works with lags, then you don't really have a cyclical fillip coming from the policy side to raise growth forecasts. Now, would the private sector capex cycle be markedly stronger than what we are anticipating now, which could raise our growth forecast? That could be an upside risk. But otherwise, I would not really, I would think that the risks are fairly balanced around our forecast right now. Okay, but let me just push you a little bit on that. Some have read the election verdict as an indication that several pockets are dissatisfied, that the K-shaped recovery has hurt large segments, which is why you saw in Uttar Pradesh, Rajasthan, Haryana, the ruling party performing badly. So would you expect, say, higher MSP or some other kind of largesse, which may disturb the fiscal numbers, but which may be positive for growth as well? So, Lata, again, from the macro perspective, the aggregate fiscal impulse is what matters. And within that, what is the mix of consumption versus, let's say, investment, right? So we think that the aggregate fiscal consolidation towards 5 or 5.1% of GDP remains intact, especially now that you have the buffer of about 30 basis points incremental from the dividend, from the incremental dividend from the RBI. Now, could there be a switch towards more welfare spending as you head into the second half of the year? That's possible, given some of the election, how you interpret the election outcomes. But that necessarily would not be incrementally positive for growth, because the aggregate fiscal impulse still for us, would remain intact, because you will have to shave from somewhere else to provide the fillip here. I think the
Fair
upside
enough.
risk again is coming from a capex cycle if it really picks up much faster than what we are anticipating.
Okay. Well, I would still wait and watch for whether there are large state packages. After all, in the portfolio, we still don't know the portfolio, but it doesn't look like the plum portfolios are going to the allies, in which case they have probably been promised or are expecting state packages. But anyway, that discussion for another day, we would know it shortly. I wanted to get your view as well on, the US non-farm payrolls, indicating that, the Fed perhaps is not cutting anytime soon. The yields have risen. I don't know if you are the point person to tell us what is the Goldman Sachs view on yields in India. Will it be like, continue to be between 6.95 and 7.1? What is your yield expectation average for the year? And rupee, more importantly.
Yeah, so we do not put out forecasts on the 10-year benchmark bond in India, but what we like because of our view on monetary policy, and we are baking in rate cuts in the later half of this year, is we like the short end of the curve. So we have a standing recommendation on a long 2-year IGB. And the main reason is because the curve, if you see in India, is now really flat. And if you think that the neutral rate in India is around 6%, so the RBI can ease up to about 50 basis points, which is our view, then the short end at some point of time is what we think will rally more than duration, and therefore we like to be in the short end. On the rupee, even with the election outcome, etc., we don't think that with the reduced majority, the macro stability which India has earned in a hard way over the last 5 or 7 years, that is getting, that is going away. We still think that the current account deficit will be narrow. We still think that the fiscal consolidation will be maintained and inflation will remain within the target band of the RBI. And therefore, we continue to like the rupee as a low vol carry currency. We have a short euro and our trade recommendation.
Okay, got that. So rupee appreciation, or rupee at least not depreciating much. Shantanu, you had an excellent report on India's savings and investment. I can't do much justice to it. But from what you are saying about rising financialization of savings and more money going to insurance, the trend you said 15% CAGR over the last few years, are you suggesting that there is a longer-term rally in the bond market, one, because, interest rates are likely to remain subdued, fiscal is likely to remain subdued, and secondly, are you seeing the rise of a corporate bond market in India for the longer term?
Yeah, so look, we think there are two implications of this. Well, broadly three. One is that the capex cycle domestically should get funded with the savings that you're generating. And that reflection is in the current account. But 2 and 3 are quite important. Second point is that you're having duration savings in India through pension and insurance. And that is anchoring the long end of the yield curve. So if you see from the 10-year point all the way up to 40, it's a pretty anchored and flat yield curve. But that the government is also going to consolidate at the same time over the next several years, which means that you're having the savings flow and the safe security supply consolidating, which means that this money has to get channelized somewhere else. We think that the appropriate one will be probably the quasi-fiscal balance sheet or some of the corporate bonds through PPP partnerships, which should be able to continue the infra financing in India. Because infra financing wants duration savings because that's the kind of ALM that they want to run, right? Their assets are long duration. The savings also would want to be long duration. And therefore, we think that at some point of time, this savings from the SDLs and GSEC, some of it will start getting channelized towards quasi-fiscal as well as corporate bonds over the medium term.
Okay, but that's extremely positive from a longer-term productivity angle. Longer private savings going into infrastructure as well as fiscal consolidation. So very quickly, Shantanu, would you want to take a jab at longer-term growth? All these are productivity-inducing. Higher capex, higher infrastructure, higher savings. Do you think that we are in for a long innings of 7%? What's potential growth?
So our estimates of potential growth in India currently is somewhere in the region of 6 to 6.5%. We think by the end of the decade, you're probably heading towards somewhere in the region of 6.5 to 7%. But one of the key assumptions that we had made was that the key structural reforms, which are difficult to implement, would come through. one being land, two being the farm sector. And in some ways, the farm sector and land reforms go hand in hand. We'll have to see with this coalition government whether we are able to pass these structural reforms. If that comes through, we think that the 7% potential growth on a sustainable basis is very much possible. If not, we think that India's growth rate is somewhere in the region of 6.5% to 7% from what we are seeing.
Okay. All right. We have much to know from even the perhaps portfolio composition, which I think we will get. We just ran pictures of Prime Minister Modi cavalcade going towards for taking over as, reaching South Block to take over. Shantanu, thank you very much. We'll have a better discussion at a later date after we know how things are panning out at the government end. Very important to know portfolios, but we could be in for something strong. Besides, the Reserve Bank Bulletin will also give us the potential growth number. We await that. Wrap up on Bazaar on that note. Chartbusters up next, and then there can be, of course, a lot of news from Delhi as well. Thanks much, but stay tuned.
In urban areas. Revival in rural demand is getting a fillip from improving farm sector activity. The Monetary Policy Committee met on 5th, 6th and 7th June. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC decided by a 4:2 majority to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF, rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. Headline CPI continues to be on a disinflationary trajectory. Monetary policy has played an important role in this process. This is evident from the decline in headline inflation by 2.3 percentage points between the first quarter of 22-23 and the fourth quarter of 23-24. Supply side developments and government measures have also contributed to this moderation of headline inflation. Repeated food price shocks, however, slowed down the overall disinflation process. According to our projections, the second quarter of 2024-25 is likely to see some correction in
Very good morning. Welcome to Chartbusters. I'm Nigel D'Souza, and joining me as always is Mangalam Malu. We have started on Monday. In style. The Nifty continues to hold in the green with a gain of around 60 points. All right. Mangalam, we've got a couple of managements. Let's get straight to it.
It's a good day. So let's get in the management of JSW Energy to understand the power sector, the impact of the elections on the power space. JSW Energy, Sharad Mahindra, who's a joint MD and CEO, joins in to take a few questions. Thanks a lot, Sharad, for joining in. With the formation of a coalition government, do you expect to see a change in policy in terms of the power space? What's your wish list for Modi 3.0?
In fact, in power space, with whatever we have seen has happened in the past, there's a recent elections, the outcome, we strongly feel that whatever the way the country's economy is growing, we don't expect any change in the growth path for the country, because a lot of work, if we see, is in work in progress. And the way, especially talking about the power sector, which is driven by in general economic growth, which is driven by the various growth in the infra sector, we don't expect that there will be any significant change in the dynamics, what we have witnessed, especially in last 2 years. Especially when we see last year, the significant change and the milestone which was achieved was that country's ambitious target of adding 50 gigawatt of renewable energy every year. Last year was the first year when the bidding and the outcome and the award was in excess of 40 gigawatt. And that all has to come on ground in next 2 years, 3 years time. So we don't see, and the way the power demand growth we are seeing, what we have witnessed, especially also the extreme weather conditions, we are quite confident that the same growth pattern will continue, and we don't see any significant change or any change in our growth strategy going forward next 5 years.
All right, sir, the power demand supply is still a concern. Evening peak demand is unable to be met by solar power demand. So what trust do you see towards renewables?
As you rightly said, that the peak demand when it reaches in the evening, and it has been a challenge meeting the peak demands. So there, plain solar, plain vanilla is not going to be the ideal solution. That will not be able to meet the peak demands. So that is where the customized solutions, which are coupled with storage, to give the green power is the thing which we are seeing that is taking shape, and we are sure that along with solar and wind, it is the storage which is going to play a key role. And countries breakup, if you ask for 50 gigawatt, this is basically a breakup between wind and solar energy. But along with that, coupled with storage, and we have seen some of the FDREs bids also have started taking place. Some states have come with plain storage bids also. So that is which is going to gain a momentum in this year and going forward also. And we at JSW are in line with this growth plan which we have. We have done the study, and that is the reason that we have already started now one of the largest, Asia's largest battery energy storage project. The work at ground has started. And we are confident that by June 25, this large capacity of storage, energy storage will be commissioned.
All right, energy storage is one of the big thrust areas for you going forward, and you see that being commissioned by June 2025. What about your own green hydrogen plans? I mean, what's in the kitty so far? What's been the capex? When does that come on stream? And will it be, only used for captive consumption, or there is some other revenue that you can generate via it as well?
Yes, I think we have just started again the groundbreaking, and the project work has commissioned just about 10 days back, which is country going to be as on today the country's largest green hydrogen project, which is 3,800 tons per annum capacity with 25 megawatt of solar capacity. This work has started. And this is basically, we are confident we'll be commissioning in the current fiscal, Q4 of current fiscal only. And this is basically to take care of the JSW Steel, our captive requirement, because JSW Steel is also venturing into green steel. So this will be a major step in that direction. And also, this will be a big learning both for us as a supplier and also for our group company to use green hydrogen in steel making. And as we have already signed a MOU with for captive requirement of almost 90,000 tons per annum by green hydrogen by 2030.
All right, so Bihar has high power purchase cost that in comparison to the national average. They are likely to push for MBED. What would this mean for JSW and the power space as such?
See, when we talk of, we have heard also that one nation, one tariff policy, which the state has already made the statement. See, this is something which is have been under discussion for quite some time. And what I feel, seeing the distributed usage pattern also for each state, because Bihar is majorly a agriculture-driven economy, the usage pattern there is significantly different when we compare to other states like Maharashtra or Karnataka or Tamil Nadu, which is a manufacturing percentage to the overall state economy is high. So I think one nation, one tariff discussions will happen. I think there are definitely challenges to arrive at a consensus, and we feel that it will still take some time to arrive on a decision for this one nation, one tariff policy.
All right, that's still some time away according to you. But what's your view on the likely price caps on both variable costs on power sold on exchanges? Do you have significant untied merchant capacity?
See, with the way the power demand is growing, and we are seeing the kind of peaks we are seeing, especially in the evening peaks and the morning peaks, and during the daytime with the increased solar capacity addition, which is happening and will continue to happen, definitely there will be excess power available during the daytime. That is what the scenario is likely to be. So, but evening and morning peak demand, the capacity addition is required. So that is where what we have decided is the storage is going to play a key role when there is excess power and the power cost is low during the daytime. That is the power which will be used for storage to take care of the evening peak requirements.
All right, sir. RBI mentions that higher provisioning will be needed for infra and power projects. Do you see tightened funding environment?
No, till now we haven't experienced anything, and I feel that again it will depend sector also or companies also, and also the records of execution. So we have deliberated. We don't expect any impact on us because of our track record, because of our healthy balance sheet. We don't expect any impact on us.
All right, and what about merchant prices? How have they panned out, and how do you expect coal prices to move from here?
See, one is that merchant prices, as we said, on a RTC basis, we are seeing a slight moderation, and that is only because that during the day when the solar power is available, the tariffs are down, but mornings and evening peaks and the night power requirements, the rates are high. So on an average, we expect the levels what we witnessed in the range of 5 rupees 30 paisa, 40 paisa last year, it will remain in the same range. And coal prices, if we see, have been quite stable for last 6 to 8 months, and we don't foresee any major change in the coal prices, and it is expected to remain range bound.
All right, so at the end of Q4, you had mentioned that you're open to both organic as well as inorganic growth plans. Any acquisition targets that you've identified? You've taken 10,000 crores of enabling provision as well, so you're bracing yourself for something big. Tell us more.
When we say that whatever our greenfield capacity additions which are going to take place, we have earlier announced of reaching 20 gigawatt by 2030, as I have said earlier also, and 10 gigawatt by 2025 in the current fiscal. So in the first phase, we are absolutely confident, and we'll definitely be crossing the first stage of 10 gigawatt before the end of the current fiscal. So that stage, what we have said is happening. We are absolutely sure because the work is already happening. Work in progress is there. And in addition to that, 20 gigawatt, what we have said by 2030, as said earlier also, we are quite confident with the kind of order book which we have built by participating in the competitive bidding space. It will be happening significantly earlier. So this is one, definitely we are sure that our plans, we will be achieving 20 gigawatt numbers much earlier than what we have stated earlier.
All right, it will be good to know that you will be meeting your guidance, at least for the first phase, much earlier than what you had stated. What about the acquired in Bharat Unit 2? Has that been commissioned in the first quarter? What would be the EBITDA contribution, and any update on the WTG manufacturing?
See, in Bharat Unit 2 commissioning, as I have said in Q1, the work is in progress, and we are confident that this will be happening within this quarter, or depending on, again, the stabilizing the unit and all, maybe 1 or 2 weeks here or there. But we are absolutely sure as of now that by month end, because the light up has already happened and the unit is stabilizing, whatever it takes will take, and we are quite confident that by quarter end, or otherwise the spillage maximum will be for maybe few weeks only, between June and July, that the unit will be commissioned. And being again low cost power, being close to the mines and the pit head plant, again, this will again, as we have seen in Unit 1, the contribution from this side, the EBITDA are going to be quite healthy.
Appreciate you joining in and filling us in with all of those details. Look forward to chatting up with you as the quarter progresses. Well, for the time being, let's shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Madhu Day of moneycontrol.com joins us to talk about a stock that she's tracking closely. Madhu?
We are talking about Safari Industries that underperformed in recent times after a stellar show in the past year. FY24 financial performance was, however, very strong, with the company clocking revenue growth of 28%, which was much higher than competition, thereby indicating market share gains. The company also managed to improve its gross margin as well as operating margin. Hard luggage, which is sourced in-house, has already touched 65% of overall sales, and the company is now embarking on capacity expansion. This expanded capacity should help Safari in staying price competitive and should have a positive effect on its operating margin as well. The company is foraying into premium segment through its brand Urban Jungle. This change in product mix is also positive for its margin. Travel as a megatrend is here to stay. The luggage industry is witnessing a shift in favor of branded products thanks to rising income and increasing urbanization. The replacement cycle is also getting shorter. While Q1 FY25 is expected to be a little softer quarter thanks to the heat wave and the elections, we see this consolidation phase as an opportunity to buy the stock for the long term.
All right, Madhu, thanks a lot for that. With that, we'll slip into a short break. On the other side, we have the management of Exigo Travels. Alok Bajpai, the co-founder, and Rajneesh Kumar, who's the director and group CEO of Exigo, to discuss their IPO, which is open for subscription today. Stay tuned. Welcome back. You're watching us here on Chartbusters on CNBC-TV18. Let's talk about the primary market action. The IPO that opens up today for subscription is that of the online travel agent Travenews Tech, more popularly, of course, known as Exigo. Its IPO is open for subscription. It's a 740 crore IPO, which consists of an offer for sale for about 640 crores and fresh issue of 120 crores as well. They've raised about 300 crore plus from anchor investors. Alok Bajpai, who's the director and group CEO, and Rajneesh Kumar now join in to discuss the company's post-listing strategy. Thanks a lot, gentlemen, for joining in. It's your day one on D Street, seeking funds from investors. Let's talk about a couple of things when it comes to your numbers and growth plans going forward, right? I was looking at your revenue CAGR over FY21 to FY23. Of course, that was skewed by the pandemic. So the number is close to around 64%. So what we want to understand is what's a sustainable growth in your top line from current levels, and what's the kind of margin band that you would operate in? I think, Alok, you're on mute.
Apologies. Even if you look at our revenue pre-pandemic to now, one of the things you'll notice is that Exigo was the fastest growing OTA in India between FY20 and FY23. We grew at about 350% in that period. So it's not just the coming out of pandemic part, but I think the fact that Exigo, which started as a utility app focused on solving for customer experience across trains, flights, buses, and now hotels, transitioned to become an OTA just pre-pandemic. And what you're seeing in terms of resurgence post that is essentially our large base of users actually starting to transact with us and starting to show up on the revenue and the top line as well as on the bottom line. I think if you look at the overall market, right, travel in India is going to be a 5.9 lakh crore industry across train, flight, bus, and hotel in FY28. And a large part of that, almost half of that is going to get done online. Now, in terms of our growth and potential, I mean, we are the market leaders on the train OTA segment, the second largest on the bus OTA segment, and the fastest growing one on the flight OTA segment. The overall OTA market is going to grow at around 18% as per the Frost & Sullivan report over the next 4 to 5 years. But I think in the past, historically, you can see that we've grown way faster than the market.
All right. So how much faster than the market can you grow? And by virtue of that, what could your market share be? It's a little over 6% right now.
So I think that's the aggregate market share on a GTV level. But if you look at the individual categories, right, on trains, we have a market share which is upwards of 52% in the OTA market. On the buses side, we are at about 12.9% of the OTA market. And on the flight side, we would be at around 5.3% of the overall market. This is the 9-month FY24 data. Now, if you look at the growth, right, the prior year on flights, we were at 3 and change. And you look at train also, we've grown from 46% to 52% on buses as well. We have grown from 11.5 to 12.9. So I think we continue to gain market share in all the categories we operate. In terms of penetration, because buses and flights, we are under-penetrated compared to the train category. I think there's strong growth potential that we foresee there. And hotels, we're just getting started. We launched in December.
Okay, all right. Hi, gentlemen. Good morning and welcome to the show, both Rajneesh as well as Alok. And wishing you all the best. And me and Mangalam as well as the entire team will look forward to chatting up with you as the time progresses. Want a couple of details with regard to your business. How do you see the revenue mix currently, and how do you see it, say, in the next couple of years, the transformation of your revenue mix? Give us a rough number.
So I think as you would have seen that we have very recently gotten into hotels, right? It's been in December last year. And these are very early days for us. But if you look at our revenue, how it has been evolving with time, we have had a head start in trains, right? So without making any forward-looking statements here, all I can say is that as our products keep evolving over time, I think some of these revenue mix might change over time because our head start on trains is what got us to like this market leadership position on trains. Because as you would have seen, the playbook of kind of solving for core customer pain areas on trains. We didn't start with ticketing, which is important to note here. We started by solving some of the core customer pain areas within, train as a vertical. And then, 2017 is when we started train ticketing, right? And then, flight and buses, we became OTAs later. And hotels, the entry has been very, very recent, like I said, in December last year. So, what we have seen so far is that this playbook of solving, for customer pain areas first, and then kind of driving organic traffic through that. So you would have seen that, 90% of our traffic is organic. And the reason for that, obviously, is that when you solve some of the customer pain areas and you're extremely customer-centric, we're able to kind of drive a lot of organic traffic.
Got it. Rajesh, let's try to get a couple of broad band numbers, which is totally in line with the regulation. So don't worry about that because we're not asking you for exact growth numbers from here on. On listing, we'll push you for that. I wanted to understand, how much of your expected share of your revenues can come in for hotels. As you said, you'll just started making an entry out there. So where do you see this number headed in the future? What's the aspiration? And also, how much of your revenues should come in from ads?
I'll take that one.
Yeah, please go ahead, Alok.
I think what you need to understand is that our playbook in terms of who we are targeting is very different here. Now, most OTAs in India that started about 15 years ago were targeting the flight first kind of customer and then monetizing from hotels once that customer was onboarded. I think Exigo has a very train first approach, and that is because we believe that the average user in Bharat or in tier 2, tier 3 cities, aspiring middle class in tier 1, trains is still the dominant mode of transport. Only 4% of Indians actually even take a flight, right? And I think from that perspective, our playbook in terms of selling categories like flights and hotels is very simple, that once we have sticky users coming to us for booking flights and buses, we are able to upsell categories like flights and hotels to them opportunistically. When an airport opens up in a town, we've seen, and we've declared this time, the numbers, we've seen the growth of flight bookings from our NBU users almost grow 90% year on year in FY24 versus FY23. So and overall flight GTV growth has been 80%, whereas the market grew at in the 20s. So I think the same playbook we are going to apply on hotels, which is to say, what does the person coming from Bhopal, from Kanpur, from Ranchi, or from Jaipur desire when it comes to hotel booking or accommodation booking, and we'll solve for that.
All right. So then final question before we let you go. We'll push you a lot more for numbers and growth estimates, etc. once you all list. A large part of your revenue, of course, comes in from the train business. And one of the risks is this increase in IRCTC charges as well. So when does this contract typically come up for renegotiation?
So, see, this is a contract which is governed by a policy. There's a B2C PSP policy that IRCTC has, which governs their relationship with all OTAs. It's a uniform relationship with all OTAs that they work with. It's not an exclusive arrangement that we have or any other OTA has. And our contract has been renewed already till FY28. And typically this is renewed under the policy. So I don't foresee a risk there of any sort. And I want to guide one thing that is very important for your viewers to understand, that look, from IRCTC's perspective, right, this is a synergistic partnership wherein we are helping them distribute train tickets to every nook and cranny of India and bringing on board the first time train bookers that sometimes come from small villages. We have 2,481 towns from which we get transacting users. In terms of split also, you must see that revenue-wise, though train appears as more than 50%, when you look at it at a contribution margin level, which is something as a disclosure only we provide at this point, the train contribution margin contribution to the overall pie is about 45%, whereas flight and bus are 55% cumulatively. So I think that pie on the margin level has evolved a lot in terms of diversification and will continue evolving there.
All right, we take your point and, we'll push you for the numbers as well. 3,600 crores, the market cap that you guys are seeking post-listing, which implies that 5.5 times price to sales is what you're asking for at the end of FY24, annualizing your 9-month numbers. That's pretty much in line with Yatra, but a steep discount to Ease My Trip. But that's also because of the big margin differential that there is. But on all of that and more, the next time. Thank you, Alok and Rajneesh, for joining in. With that, we'll step into a short break, come back, get you more on the markets and a lot of stock-specific action. Stay tuned.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and investing.
Welcome back. Well, most markets are trading in the green this morning, which is good news. The Nifty is still holding with a gain of around 50 points. We've come off a little bit from the top. The Nifty Bank is up 50 points odd. I think all the indices that I'm looking at, they're either up between 50 to around 80 points. So a bit of consolidation is what we're seeing. But just to pull up a few stocks for you on the screen, Heritage Foods, the stock was up close to 10%. That big bounce has got sold into. So, that stock should come up for you on the screen. KCP is the other one as well that was up close to around 10%. So remember, these are stocks that move 40% in the last 4-5 sessions. That one as well as almost in the red as we speak. You spotted a few, Mangalam?
On Heritage Foods itself, Nigel, it's doubled in the last 12 sessions. So maybe some profit booking can't be ruled out. So as you pointed out, those are a bunch of stocks which we are watching out for. We wrap up on this edition of Chartbusters on that note, and the team of Trading Hour will take the market action forward. Thank you for watching.
Key news makers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage.
Hello and welcome to Trading Hour. It is Monday, 11 a.m. and we are here with all the cues. I'm Surabhi Upadhyay. With me is Hormaz. And Hormaz, I don't know about the political circles, but 400 par happened. 23,400 was crossed in the opening trades. So the market did make all-time highs, and there was a cool-off that came in. And right now, the buying has come back in. So what's very, very clear that this remains a bit of a buy on dips market because the dips are getting bought. That's the important point. And in terms of sectoral participation, it's a complete mix today. You've got economy-facing stocks doing well. You've got something like a Nestle, which is consumer, Britannia, which is consumer. That's doing well. There's been some buying on the big blue chip names like Reliance, like State Bank of India. So there's plenty to keep the green side of the screen fairly active today, Hormaz.
The question is how much of a dip is too much of a dip, right? Yeah. Because the dips that come around 20, 30 point dips and they get bought into. But yes, the market is doing well after making 23,400, slipped into the red slightly. But par for the course, I guess, considering the week that we had the last time around, right? We have we making record highs, then losing biggest single day drop in 4 years, losing 30 lakh crore in market cap and then recovering all of that in the next 3 sessions. It just sums up the state of the market that we are in. The broader markets also are doing well. The PSU banks are doing well. Real estate is doing well. So as Surabhi just highlighted, it's a broad mix of stocks and sectors that are doing well in today's trading session. There you can see the PSU bank index up 1.5%, as is the realty index as well. PSUs in general are also doing well. Power Grid is the top Nifty gainer in today's session, is up 4%, as is Ultratech. Cement stocks are doing very well in today's trading session as well. But we have Unmesh Sharma to start the show with. He's from HDFC Securities. He's joining in to discuss some market fundamentals as well. Unmesh, good morning. Thanks a lot for joining in. What do you make of this market, Unmesh? How do you approach a market like this? Because you are up 3% one day, down 6% another, then up another 3% the next day. The retail investors made the most of this fall. But do you think now it's time to take a bit of a pause, or do you think that there's still more steam left ahead?
Yeah, good morning. I think if you had gone to sleep on Saturday and woken up today, you would have realized nothing's happened at all. I think it's interesting to see how all of this has played out. But in any case, I think the fact of the matter is that this volatility on a daily basis should reduce going forward. One key thing being whatever speculation there was about the formation of the government and all seems to have been put to rest now. Very clinical and efficient execution by the ruling party in that sense. Okay, so all from a market perspective, it's back to business as usual. I think with the exception of a little bit of, consumption and rural kind of focus, which is incrementally happening, we see absolutely no change in the way in which the government will approach either the public finances or, the sectors on which they're focusing. So, it's very similar to what we would be saying last week, for example. On the large caps, there's a little bit more value, but that is also where the price discovery is happening because the FPIs have the ability to sell and leave the country. But in the small and mid caps, wherever earnings delivery is there, we continue to strongly believe that incremental flow should be invested in companies which are delivering earnings. So it will remain a stock pickers market. Maybe the market's absolute level may go sideways for some time, given how expensive it is. And as we roll forward to FY26, maybe after Diwali or so. But for the time being, I think in the small and mid cap space, the buoyancy should continue.
Okay, all right. Unmesh, hi, good to have you on the show. I remember, a conversation that we had earlier this year. I think it was around March or April. At that point in time, you weren't very optimistic on consumer staples because of obviously the concerns on growth and the fact that it was very anemic sort of, a low single digit kind of volumes that most of these companies were doing. Now the environment is different. Now there's talk of maybe some more populism, at least some more spending on the rural side. Some of these companies have had very good commentary in the fourth quarter result season as well. So what's your sense? And in terms of portfolio stance, is there any shift away from some of the economy-facing names to maybe consumer?
Okay, so look, on consumer, I think, that was our stance, absolutely right. And it's worked well, interestingly. So, quite happy to have that. That has changed a little bit, okay, for 3 reasons. One is that this is the type of market where if there is a story, even if the earnings are going to be delivered a year or 2 later, you would still want to kind of play that, it's that type of market. So with the change in the way in which the government went from a single party majority to coalition and some of the trends that we saw in the elections, we believe that incrementally for the next 5 years, the bottom of the pyramid consumption support will remain important. So from that perspective, rural becomes important. The second is something which we knew already, which is that we are expecting a very strong monsoon. And hence, if you put these two together, what we have done is that we have introduced some rural-facing names into our model portfolio. So it's not a shift really away from government capex, because that I think will continue to remain a big theme. But at the same point in time, taking some money away from cash and some of the things like InvITs and putting them into. We have increased our weight, even though we are overall underweight, but increased our weight on things like Maruti. We have added Britannia, and then V-Mart and so on and so forth. So to play the rural theme.
Okay, so just to follow up on that, you said you've increased the weight on Maruti and added stocks like Britannia and V-Mart to the mix. V-Mart, I guess, because they have a great footprint in tier 2, tier 3.
There is rural tier 2, rural and tier 2. So it's not necessarily just completely that.
Fair enough, fair enough. So V-Mart makes sense. Just on Britannia, I mean, why, when you're talking top pedigree FMCG, why Britannia?
So look, we do have Hindustan Lever. In fact, interestingly, Hindustan Lever, just because of valuations, actually there was a big gap, which we have cut. So we have come closer to the index, but we still remain 100 pips underweight. But what we wanted is something which is in the index. So Britannia is in there, and we wanted to also have enough market cap to be able to play that. So incrementally, if you look on a relative value basis, that is the one that we've added in there,
What about IT, Unmesh? That's the only sector that's not doing well today. And it was one of the top performers last week. The index was up 9%. There's also some supply coming in, considering a large promoter stake sale that you've seen in Emphasis today, likely stake sale as well. With macros not changing as much compared to FY24, do you still believe that the guidance that these companies have issued, say for the likes of Infosys and HCL Tech, do you think that is ambitious even with the conservative stance that they have taken?
So look, IT, we are long-term believers. We believe that these are all phases when, there is always this confusion about discretionary spend and, shift. It could have been Y2K, it could have been digital, now it is the cloud, and now finally AI. But eventually, they will muddle through and kind of rise to the challenge. Overall, if you look at IT in our model portfolio, we have a 100 pip overweight, which is something that we've increased recently to slight underweight. Because of three reasons. One is that there was a relative underperformance and the valuation gap is there. And in the large caps, we believe that relative value is the game in town, given the fact that FPIs are also actively participating. But more importantly, what we do have is that on the IT, is that we have taken out of index and even out of classical IT bets. So what we do is that in our IT portfolio, for example, if you look at out of index, we have Emphasis in there. So amongst the classical names, so as to speak, and then, Tech M, we are overweight. But we also have things like MCX and TeamLease, which are like, kind of technology enabled, so as to speak. So that's how we are playing this. So services, we are a bit underweight in a sense, but if you look at the entire IT pack, we are overweight.
Okay, so let me end by asking you a very simple question, Unmesh. Given the new era that we are in, Modi 3.0, in your model portfolio, I'm not sure what the top weights are, but let's say what should be the top 5 stocks that everyone should have in this new era now?
Okay, I have to pick up my piece of paper to actually able to answer that. But I think we have, let not be too stock specific, but basically, if you look at large banks, we have the large banks in there. We still believe that in the large caps, we have relative value in there. We are playing financial inclusion and participation through things like insurance, and we've cut our weight on consumer discretionary. Finally, after being underweight for a long time, we've introduced things like Orient Electric and Crompton Consumer there. So that would be the third. And we continue to remain very positive on the domestic, infra-facing companies. So cement and building materials is another 100 pip overweight. And to round off, I think bottom up, we do like some of the pharma names. We have a new analyst, who's been quite positive on names like Dr. Reddy's and Cipla. So yeah, that's how we round up. These are the 5.
Just a clarification, you've cut weight on consumer discretionary, but you still have Orient Electric, Crompton Consumer. These are still stocks that you like.
No, cut weight as in we were deeply underweight. We've got very less underweight by adding these names in there.
Okay.
We were, through the year, we've been very negative on the consumer. We're kind of changing that now.
Well, Surabhi's questions, simple questions are not so simple after all. But Unmesh, thanks a lot for joining in and spending time this morning highlighting your sectoral and stock-specific preferences as well. That was Unmesh Sharma there of HDFC Securities. Time for a short break here on Trading Hour. Up next, we get you what's buzzing in the commodity space. Manisha Gupta joins us on the other side.
And healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
So the whole debate was whether you should be unloading of PSUs, unloading of capital goods, manufacturing, infra, and moving towards defensives. And we saw that on Tuesday. There was this massive rush for safety. So anyway, let's talk about valuations and how these numbers have absolutely converged. It's been a story, a study in itself. So these are numbers FY26 for some of the prime capital goods stocks. And many of them are, of course, MNC companies. So ABB is right at the top of the pack, 92 times. Hitachi Energy 78 times. And look at the corresponding moves in stock prices. Valuations are up because these have become growth stocks. At one point in time, they were value stocks. But look at the appreciation. Hitachi Energy is up 163%.
Back with us here on Trading Hour, and now time to get you what's buzzing in the commodity space. Manisha Gupta is with us. Manisha, good morning. We're putting the spotlight on precious metals. What's the update there?
Oh, well, yes, we've seen a profit taking. You know, April and month of May were great, stellar months. We've seen gains come in for across commodities as a sector. So whether it was energy or soft commodities or metals for that matter, and precious metals as well. But June has been slightly shaky, and we've seen a definite profit taking coming into this space until now. The biggest trigger until time clearly has been the US non-farm payroll data coming in the highest in 5 months and easily beating the street estimates, and much on the higher side is where we've seen the numbers come in at 272,000 jobs being created in US. Now that has led to people pushing off in sense of interest rate cut expectations from a nearly 70% probability in the previous week. It stands at 50% probability of a first rate cut coming in for the month of September. The one rate cut that could come in this year, the markets anticipate that would be in the month of November. Now this has led to profit taking in precious metals for sure. Gold prices, after hitting an all-time high at $24.50, are now trading below $2,300 an ounce. We saw 2% of a cut in the previous week, and gold with that is trading at a 1-month lows right now. What also is weighing on gold is China's central bank buying, which was absent for the month of May. So China, after buying gold for 18 straight months, has not bought any gold in sense of its central banks in the month of May, and that also has led to some profit taking coming in here. Same situation for silver also, where we saw prices decline 4.5% in the previous week. Here as well, the prices did hit an 11-year highs of $32, but it's trading below 30 right now. So this one also is a 1-month lows coming in for silver. For silver, what is also weighing is US imposing 50% tariff on China imports in sense of solar panels. So that has put some pressure here. Also, when you look at the markets going forward from here, it is going to be about the Fed policy decision that comes in on Wednesday. The retail inflation data comes in on Wednesday as well. So these couple of data events, and ahead of that, some jitteriness is what you can expect.
Okay, all right. We'll watch out for that. Thank you very much, Manisha, for the latest. We do have to take a very quick break. We'll come back on the other side. And then some technical trading ideas coming up. Of course, a quick check on the indices as well. They've done really well, 80%, 90% growth in these stocks in the course of the last 1 year. Thermax, 127%. And look at GE T&D, 535%. So valuations on these capital goods names, which are many of them are MNCs, they're ranging anywhere between 50 times, going all the way up to almost 80 times for some of the names like ABB. Now, contrast this with FMCG. FMCG was the original sector that would trade at 70 times. Those were the heydays of the staples era. But now that's changed. So Nestle is the one that's, if these are FY26 numbers, by the way, that I looked at. So about 60, 61 times on Nestle makes it the most valued stock. Godrej comes in at a second at about 50 times. Lever, so these valuation multiples, they've been trending down. Lever itself is at 50 times. They're obviously at a discount to what the historic averages were. Colgate at 48 times. And look at the stock price performance. Lever hasn't moved. I mean, throughout the year. The others are up anywhere between 7-8% to about 11-12%. These have done a little better. Marico, for instance, slightly better. But even here, the valuation multiples have all come down to the 40s, mid-40s. And it's the capital goods space where the valuations have moved up to 80 times. And that's the change that we're talking about. Whether this event that happened, whether that offered a bit of an opportunity for a reset.
He was the man of the week itself, right? He's got close to around 16 MPs, and he was a kingmaker, actually. And who would have thought? Now, there are a few stocks that are moving around based on the so-called Naidu effect. Heritage Foods, he's the promoter entity in there. And, just looking at it, well, the fundamentals as well of the company have been improving, or that's what the street believes as well. So the last year they did around 11 rupees, but the next couple of years the street believes that it's going to go to 22 rupees. So they believe there's going to be an improvement on ground. Looking at the valuations, even after this 50% move that we saw in this week itself, well, it trades at close to around 31 times. The 5-year average is around 29 times. So in that context, it's not very, very expensive. What is the street factoring in? How come the EPS goes up by so-and-so? They are expecting the value-added products, that was around 30%, to scale up to high 30%. How is that possible? Well, they have been mentioning this, in their con calls as well as in the presentation that they put out. Also, they had some high-cost inventory of, SMP. And out there as well, they are expecting that, in fact, that high-cost inventory will be out of the way. And if you just look at the margins, well, they've come down drastically to around 5% in comparison to around 11% odd. So both of those are the triggers that are going to be working for it. And that's why the margins are expected to improve from here. And that's why the EPS as well is expected to move from here. Well, next up, let's move to Amara Raja. You have Mr. Gala, who was a TDP member. He was also a member of parliament from Guntur. This time around, he wasn't, standing for elections from out there. But in fact, there is that bit of the TDP play, so to call it, for Amara Raja. Besides that, besides the core business, they're also talking about cell manufacturing facilities. And the cell manufacturing facility.
Back with us here on Trading Hour and putting the spotlight on some stocks that are in focus this morning. And one of them is PI Industries, which is under pressure after a key consumer Kumiai has lowered its guidance, and Sonal is here to join us with more details. Sonal, what is the guidance that the key customer has given?
Well, they've cut the guidance. Remember, their fiscal year starts from November and ends in October. So that is how we look at the fiscal or the financial year for Kumiai. Now remember, they had given a guidance in December, and now in the first half, they've cut it by 9% further, citing issues around inventory restocking and global channel as well in terms of agrochemicals business. Now remember, PI supplies pyroxosulfone, which is active ingredient for Exigo, which is an important product for Kumiai. Pyroxosulfone is the largest export product for PI's CSM segment or the export segment, and there have been questions around pyroxosulfone losing its competitive edge or pricing pressure as well. So this has come in as additional or incremental news flow, which is negative for the company as well. Lower guidance is due to global destocking. The company also speaks about how agrochemicals, the sector is facing an issue, and that continues to be the pain point for PI Industries. The management has alluded to these fears in the past, saying that they are expanding their portfolio and there will not be so much dependence on this particular product itself. However, the issues continue.
Indeed, and the stock is also under pressure now, almost 2% lower. But Sonal, stay on. There is also a buzz of the gas sector being included under GST. What do you have with us on that?
Well, you know, there have been a lot of talks earlier as well, but again, these talks have resurfaced where there could be a possibility of gas coming under GST. In fact, Mahanagar Gas had its analyst meet takeaways where they did indicate that discussions are underway to get natural gas under the GST regime. Comments have been sought by end of June 2024, that is this month itself, on the new central excise bill. Now remember, right now, the taxation on gas is as under excise duty at 14.5% plus state VAT plus procurement tax. So what happens in this case is input on the inputs there's GST, but there's no output GST, which does not allow companies to take input tax credit, and it leads to higher costs for them. But the company says now they expect 12% GST rate on gas, and this could benefit stakeholders across the value chain. And this is similar to what brokerages have been saying as well. Citi, in fact, last week wrote that NDA could consider bringing gas under purview of GST, which could benefit the entire value chain. IIFL says that they believe NDA could consider this in the next 12 months itself. And if that does happen, it could further improve sectoral fundamentals. So that is basically the gas value chain. Jefferies has been very specific. They say government is reviving talks to include natural gas under GST, which could lower the gas cost by $0.8 to $0.9 per MMBTU. Andhra Pradesh, Gujarat, Uttar Pradesh and Rajasthan are the 4 largest beneficiaries of VAT on natural gas, because that is where we have the major gas fields. Now, GAIL's consolidated EBITDA could rise by 2%, assuming it retains the benefit in the LPG segment. Gujarat Gas's competitiveness would improve versus propane by 6%, and CNG companies should see higher volumes or higher margins depending on whether they pass on the price cuts or not. But if it does happen, it will be positive, but we'll have to wait and watch, because previously as well, we have seen such rumors.
Wait and watch, as always, has been the case in such issues, isn't it, Sonal? Thanks a lot for both of those updates, actually, on PI Industries as well as on gas stocks as well. But moving on, a couple of other stocks that are also buzzing on the back of earnings and the recent news flow. Vamakshi is here with more details. Vamakshi, which are those stocks?
Well, absolutely, Hormaz. Let's keep an eye out on PTC India. The stock is reeling under pressure today. We pointed out in our top 10 segment as well, and we pointed out that the revenue saw a degrowth of almost 2%. They now stand at 3,216 odd crores. The margins have improved slightly by around 20 basis points from 4.1% to 4.3%. But the net profit has taken a beating, down nearly 47% YOY. And in fact, this is mainly on account of exceptional operating expenses, which came in at 20.5 crores in the fourth quarter, mainly towards surcharge on sale of power. So weak set of numbers coming in from PTC India, the stock reeling under pressure. KEC, on the other hand, is surging in trade today after the company announced that they have won new orders worth almost 1,061 crores in their railways, T&D as well as cables business. And with these orders, their year-to-date order intake now stands at over 3,000 crores, which is an uptick of almost 30%. RailTel Corp is the last one that we will be focusing on. Order wins here as well. They've received a work order for National Informatics Center Services worth almost 81.5 crores.
Okay, all right, got that. So those are a couple of stocks in focus. Vamakshi, also tell us about Suzlon. I mean, there's been so much chatter about the resignation of this one independent director, citing some sort of maybe misses in corporate governance. The stock was slightly lower last I checked, about 4% down. What's the latest on this?
Well, absolutely. Suzlon is reeling under pressure today, and that is because Mr. Mark Desailly, who's an independent director, resigned with effect from June 8, 2024. Now, he has cited corporate governance standards applied did not meet his expectations, including situations where communications lacked his expectation of openness and transparency. Now, keep in mind that he was associated with the company since April 2012 and was slated to, his term was slated to end in September 2024, but he has resigned before that, citing these corporate governance issues. But on the other hand, the management held a conference call yesterday, and on that call they clarified that issues raised were soft in nature and process oriented, and they said that this will be implemented in due course. They, however, highlighted that none of the suggestions revolved around financial or operational irregularities or non-compliance with the law. They reiterated that all legal as well as financial disclosures were fully complied with as far as regulations are concerned. We also have a note coming in from Nuvama on this whole matter, and they say that Suzlon is turning around its financial position and the operational ramp-up is also expected to come through in FY25. The management is looking to address the needs of the business first, and they intend to implement the best-in-class suggestions in due course. So given all of those factors, they have not changed their rating. They've given a buy rating on Suzlon, unchanged target price of 53 rupees per share. But definitely this announcement does have a bearing on the stock today, and the stock is reeling under pressure.
Well, Amakshi, thanks a lot for that update on Suzlon. Suzlon has been in focus all through 2023 for the surge that it saw almost through this year as well. It's almost up 30% before today's drop. It's almost a binary, Suzlon. It's either an upper circuit or a lower circuit. It's trying to find a middle ground today. It's down 4%, closing on levels of 50. And there have been a pretty recent analyst initiations as well on Suzlon. Some of them having targets of 53, 54, one of them even having a target of 60 as well on Suzlon. But today, stock under pressure, down 4%. But moving on then, Samvardhana Motherson is on our radar after Moody's upgraded its credit rating to Baa3 from Ba1 with a stable outlook. Upasna is here with more. Upasna.
Thanks so much for that. Moody's rating has upgraded the credit rating of SAMIL and SMRP, a wholly owned subsidiary of Samvardhana Motherson. The long-term rating of both the companies has been upgraded from Ba1 to Baa3 with a stable outlook. In terms of stock move, the stock has seen an uptick of 6.5% in last 1 month and as high as 57% in last 1 year. Company reported a strong Q4 and FY24 numbers, and looking at the management commentary and outlook of the company has indicated that Europe and North America are 10 to 15% below pre-COVID levels, and emerging markets are driving the growth of the company. FY25 capex plan is 5,000 crores, out of which 2,000 crores will be spent on 18 greenfield projects, and the automotive book business is seen at $84 billion in FY24. 23% of the company's automotive booked business is from EV, and the company is eyeing on newer segments like aerospace, healthcare and medical, and consumer electronics for the growth going forward.
Okay, all right, got that. Thank you very much, Upasna, for the latest on Samvardhana as well. That's favorable news flow, working well for the stock. Let's now go across and say hi to Soni Patnaik, who's joining in. She's, of course, from JM Financial Services. Soni, good to have you on the show today. So some volatility, but the dips are getting bought. What would your advice be on the indices to start off with?
Hey, good morning, Survi. Thank you for having me on the show. So if we talk about Nifty today, we can see that it has crossed the previous all-time highs and it's quite sustaining above that. Of course, there's a lot of volatility, but from current levels, 23,500, 23,600 is the range where it can actually test and then see some resistance or maybe profit booking. So if somebody is already holding these levels, then you can continue to hold until you can see the levels of 23,500, 23,550 and just book your profit. So for fresh entry, it's just not quite wise from current levels. Maybe if because the stop loss is not going to be quite intact from current levels, as the support is around 23,100 for now. So for fresh entry, after you've seen the profit booking coming in, just wait for that dip to come again, and then you can reinitiate the longs around 23,100 as a stop loss. Talking about Bank Nifty on similar lines, Bank Nifty has also crossed the levels. However, Bank Nifty from current levels seems to be slightly better than Nifty, and it can test 50,500, 50,700. So I think that's holding quite well with a good support of 49,400 for the day. So I think Bank Nifty is something that can be looked at.
Indeed. What about specific stocks? Sony, what is on your radar this morning?
Hi, good morning, Armaz. So the first stock would be from the pharma space. We're seeing quite good momentum. The stock is Zydus Life. So we're seeing a good fresh breakout in Zydus Life. One can buy at current levels, keeping a stop loss of 1060 and a target of 1120, 1125 can be seen in Zydus Life. The second pick is in Indus Tower. So this stock also has seen very good support around 340 levels and continuously moving from those levels. It's defending that support very well. So it is quite likely to test higher levels of 370, 375 from current levels, keeping a stop loss of 340.
Zydus Life and Indus Towers, two recommendations there from Sony. Thanks a lot for that and your updates on the index and specific stocks as well. Time for a short break. Up next, we get you a discussion on ICRA's latest report on why they see a slowdown in the domestic commercial vehicles industry for FY25. Stay tuned. Back on the other side.
Something that is likely to come on stream in the second half of FY26. The capex that they've laid out is close to around 1,200 crores. They're talking about an asset turn of around 1.3 to around 1.4 times odd. So that's going to be the key trigger fundamentally that we're looking forward to. In terms of valuations, the stock has gone up big time, but it still trades at around this 24 or 22 times odd. So that's on the valuation chart. Moving to the cement and the infra themes then. The street believes that Mr. Naidu is pro-development, and because he's pro-development, cement will do well, construction as well will do well. So there is that pro-development agenda that's likely to come. And remember, when he was last in the hot seat as a CM, Amravati, that was the capex plan that the street was looking forward to. But when he lost the elections, well, then that complete plan went out of the window. So they're hoping this time around as well, the Amravati big capex plan will come on stream again. And because of that, you've seen stocks like KCP, you have Ramco, Sagar Cement, all of them, well, that's their capacity that they have in Andhra Pradesh as well as Telangana. And that's the percentage of their total capacity. So as you can see at the bottom of your screen, these three companies, in fact, 80 to 100% of their capacities are in this region. So they could stand to gain. The other couple of names, NCCA and KNR Constructions, both of them saw a big rally this week. A lot of factors out there, but just to highlight three factors. One is that Amravati capex plan that we're talking about. There were also some pending dues that didn't come about. The street believes this time around they'll get cleared out. So pending dues will get cleared out. And besides that, you have the fresh orders that could come about. So you have Heritage Foods, where he is the promoter entity. Amara Raja, there's a bit of a TDP connect out there, and there's a fundamental reason as well. And cement, as well as infra companies, they could stand to gain. Undoubtedly, the MVP of the last week was Mr. Chandrababu Naidu.
Looking ahead, the result.
Welcome back. Here with us on Trading Hour. We are now focusing on the auto sector. A report by ICRA says that the domestic commercial vehicle industry's uptrend is likely to be arrested in the current financial year amidst moderation in economic activity in some sectors due to perhaps the general elections and some overall slightly tepid trends. We have with us Kinjal Shah, Senior Vice President and Co-Group Head Corporate Ratings at ICRA. Kinjal, it's good to have you on. I was just looking at the note that you folks put out, and you're expecting that for, I think, medium and heavy commercial vehicles, there's actually going to be a decline in volumes, 4 to 7% decline. So where's the sense of caution coming from?
So let me just take a step back and go to some history. So post the pandemic, if you see the CV industry witnessed a sharp growth in volumes in FY22 and 23. So around 26% in FY22 and roughly around 34% in FY23. So this created an enlarged base for the industry. Now on this high base, the growth momentum overall for the industry did witness a slowdown in FY24, and it ended with a 1% YOY growth. And our expectation is that the overall CV industry would witness a decline of around 4 to 7% in FY25, as you rightly mentioned, because of the moderation in the economic activities in certain sectors in the backdrop of general elections. Now, coming to the M&HCV industry, So this industry, which is largely 7.5 ton and above segment, that accounts for around 33% of the total CV industry. And this industry witnessed a flat growth in FY24, and we expect that it will witness a decline of around 4 to 7% because primarily the end user of this segment is the infra segment, primarily the cement sector, steel sector, etc. So here in H1, at least we expect that there would be a YOY decline in volumes because of the slowdown in the infrastructure activities during the election period. H2, we do expect that there would be a YOY growth in volumes. However, our estimate is that the growth in H2 will not be adequate to compensate the loss in H1. And that's why we would see this decline of 4 to 7% overall in FY24.
Kinjal, just to get this right, this is not a high base effect problem. You're saying the moderation in activity and largely because of elections, or is there more to it than the usual, election-related slowdown in ordering?
So typically it's perceived that during the election period that the multi-model code of conduct sets in, and during the election period there is a slowdown in the infrastructure activities, and typically the sectors which are connected to the infrastructure activities that would typically see some slowdown during this period. That's why our understanding is that Q1 and overall H1 that would see a moderation, and H2 we would start seeing a rebound in the activities and thus the growth.
But Kinjal, if you are mentioning that the growth in H2 will not be enough to compensate for the losses in H1, do you believe, is that a continuation of the sluggish trend in demand in general? Because in that case, if there is already a lack of demand in the first half, which is causing the volume contraction, the demand would slightly improve, but still not as much as the first half or as the previous years have been.
Yeah, so typically, I mean, if you see the CV industry is cyclical, and like I mentioned, FY22 and 23 saw very high growth, and FY24 we reached overall volumes at around 9,67,000 odd units, which was just below the peak in FY19 of around 10 lakh units. So the base itself has become very high, and because of that cyclicality, we would see a period of slowdown which would stem in, and this would coincide with this period of the general elections. So both these combined, we expect that would see result in moderation and that growth in FY25.
Okay. Kinjal, just hold that thought. We are just also looking at some numbers that we've got from the mutual fund industry, and that's a massive inflow number. I think the net equity inflow number, 34,670. We've not seen, this is probably an all-time high, by the way, in terms of monthly inflows, because at the peak, these flows were touching 23,000, 24,000 thereabouts, and then there was a decline all the way to just about 19,000. 34,000 is absolutely massive, and it ties in with the other data releases that we're seeing from the exchange level as well, that retail has been buying, through mutual funds or through direct, but retail has been buying all the dips in the lead up to the election result, and even after the election verdict volatility, we saw it was actually retail buying. And that's a very, very big number coming in on the mutual fund flows. Let's just look at some of the other numbers that are coming through. The flow in the large cap fund category continues to be fairly small. Large caps are not drawing the money, but it is, the mid and large caps, yes, they are getting more of the numbers. Large cap, I mean, yeah, it's increased month on month, but it's nothing compared to the other categories. The mid and large category, the multi-cap categories, they are the ones that are getting, okay, that's a very big NFO number as well. 10,000 crores coming in via the NFO route. That's a massive number, right? It's 34,000 crores. The mid-cap number also, actually 2,600 crores was the mid-cap fund flow, which is almost the highest since November of last year based on what I can see here. So substantial inflows. The mid-caps are drawing the money. The large caps, an increase from last month, but yes, as Ruby highlighted, it continues to remain tepid as compared to mid and small caps. The mid-cap fund flow, there you can see 2,605. The number in November was 2,666. So it's almost at par with November of last year. So that is some positive data coming in there for the mid-cap. Hybrid fund flows also slightly lower on a month-on-month basis, but mostly flat, around 18,000 crores. They were 19,000 crores in the month of April as well. But the overall, the big number is the net equity inflow, which is almost at around 34,000 crores. There, big number coming in. Absolutely. One of the big launches in the NFO category was the SBI Automotive Fund. And typically, whenever SBI does an NFO, expect large numbers to come in. So a lot of this flow would have been mopped up by that one fund. And there have been other releases as well. The flows are back in the small cap category as well, as Hormuz also pointed out. Mid cap, small caps, they continue to get in the money. Large caps, I mean, contrast the 600 odd crores that's come into the large cap category. It's far sort of lower in comparison. So all in all, of course, the SIP number will come with a lag, but SIPs have been very steady, clocking those steady sort of inflow figures of around 20,000 crores on a monthly basis. We'll get that number in a bit as well. But this is looking pretty good in terms of the MF inflows coming in, and a very sharp reversal of the trend of petering flows that we were highlighting over the last couple of months. It's very, very clear that when there was volatility, retail investors decided to go all in, and that's showing up in the equity inflow numbers as well. So more on this as we go along. Once we get the SIP number, we'll have more of a... Oh, by the way, that's an important category as well. Hybrids are constantly attracting a lot of flows, and the industry as a group is focusing a lot on the multi-asset category and the hybrid category. For instance, balanced advantage. I mean, the communication from the industry has been about keeping asset allocation in focus, given the elevated levels that the equity market has been trading at. And it seems that communication is working, because hybrids are consistently getting good flows, including, of course, some of the multi-asset funds as well. And also, hybrids, in some of the hybrid categories, the taxation is far more favorable. You manage to get equity taxation because the bulk of the fund is either in equity or in arbitrage, and therefore the whole thrust is to look at hybrids as a very tax efficient way of taking exposure to both categories, I mean equity and debt.
Having the best of both worlds, I guess, in terms of the hybrid funds, right? Almost 18,000 crores, not a bad number. It's still lower month on month, but still almost on at par with the flows in April. But there you can see the large cap, the main fund flow, the 34,000 crore number is the highlight of this release from AMFI there. It's a record high, 34,671 crore as we speak. So, but we'll get more reactions as we get the SIP number as well. But we go back to Kinjal with our conversation. Kinjal, thanks a lot for staying by and being patient with the numbers that came out from AMFI. Oh, we get back to that as well. So the small cap funds there, 2,700 crores, the flows there as well. So numbers picking up for the small cap funds as well. They were a bit lower towards the month of March. They had seen some outflows. Then they had picked up in April at around 2,200 crores. Now they're at 2,700 crores as well. So mid and small caps continue to see healthy funds. But overall, the main inflow number is the big one.
The other category which is getting a lot of steady flow is flexi cap. By the way, this month, in the reporting month of May, flexi cap funds have gotten more money than large caps, mid caps or small caps, the individual categories put together. So again, the narrative that allowed the fund manager flexibility to go across market capitalization, depending on where the fund manager finds good value at that point in time, looking at the market's construct and structure, that seems to be working, because 3,155 crores have come into the flexi cap category. Sectoral and thematic funds, look at the giant surge over here. 19,000 crores have flown into sectoral and thematic funds. A lot of that, I mean, as I explained, one of the big funds was this automotive fund coming in from SBI. But in general, a lot of thematic launches are happening, because remember that mutual fund houses are restricted. They can only have one fund per category. So if you have large cap, there can be one large cap fund, one mid cap fund. But you can have as many as you want in terms of sectoral and thematics, newer niche sort of themes on which fund houses can launch products, and that's what's happening. I mean, there's been a huge push on the sectoral and thematic category. Let's take a break. We'll try and get you some more perspective on these numbers as we go forward, but looking very good in terms of equity inflows for mutual funds in the month of May. Back in a moment.
To be nimble and flexible in its liquidity management through main and fine-tuning operations in both repo and reverse repo. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner which preserves financial stability.
Welcome back. You are with us on Trading Hour, and let's just look at the market as well. The market's holding steady, about 50 points higher, not much has changed. So the Nifty continues to look at some green. The mid-cap index actually is absolutely in sync with the Nifty today. And the Bank Nifty also not too far behind. Bank Nifty is up about 0.3%. So for a change, you've got all the indices absolutely at par and in sync. And there you have the big visuals coming in from New Delhi, the visuals that everyone's been waiting for. Prime Minister Narendra Modi taking charge for the third time, third consecutive role as India's finance minister, only second person to have that honor after Mr. Jawaharlal Nehru. So there you see the shots of Prime Minister Modi taking charge. Now, of course, the much awaited release on the portfolio allocation. That is what everyone's really waiting out to know who gets which portfolio, and of course, where will or who will head the key ministries like finance, like corporate affairs, and so many others, home, etc. I mean, many, many important ministries. So we are waiting for the portfolio allocation to come in now that the Prime Minister has taken charge. So maybe we should have that also in just a bit. Okay, as promised, let's get back to those numbers coming in from AMFI. We have Abhishek Tiwari, Executive Director and Chief Business Officer at PGIM India Mutual Fund joining in. Abhishek, great to have you with us. So that net equity number is massive. It's gone above 30,000 crores this time around, right? And that's a huge jump, considering we were in a bit of a declining trend so far this year. What do you think has gone behind it?
So first of all, thank you for having me. I think what has gone behind it is the linearity of returns that continues to follow. I think we haven't really seen a trend which is one way down. But having said that, I think it also, in a manner of sorts, shows the evolution of the investors, where for every dip, there are new and new buyers. When you look at the folio numbers behind these, absolute sales numbers, you will realize what I'm talking is what is making sense. And in addition to that, I think the sectoral and thematic, stories and the narratives which are adding up to what is happening at the broader economy is clearly being able to drive the sales up.
Abhishek, good morning. Thanks a lot for joining in. The large cap funds, they may have picked up from the month of April, but they still remain pretty tepid in comparison to the mid caps and the large caps. There's a lot of consensus on the street going on that the large caps are the ones that offer more value compared to the mid and small caps, but the flows are suggesting completely otherwise.
Yeah, so I think there's always going to be that tussle between shorter term trends and longer term performance. The shorter term trend clearly suggests that the value available in the large caps versus the segment of the market which is small and mid cap, which has done a stellar run over the last 12 to 18 months in specific, clearly offers a lot more value. And I think as a fund house, we have been out there saying the same thing for over 6 months now, if not longer. So clearly there's more value when you think of looking at that segment from a risk return in the near to the medium term. But having said that, obviously the longer term picture, because of the 18 and 24 months performance in small and mid caps and also the thematic funds, is clearly painting a different picture for the investor.
Yeah, exactly. I was just coming to thematics because Abhishek, this is an eye-popping number. I don't remember ever seeing an inflow of 19,200 crores in thematic funds. Some of this would be because the NFOs are thematic in nature, right? I think SBI's, NFO was the auto sector NFO. But again,
yes.
What further intelligence can you share with us on this huge number and the trend, more importantly? Because the purists will say that handle thematics will care, don't go overboard with thematics in your portfolio. But these numbers are absolutely, gravity defying.
So what you're saying is totally making sense. I think the numbers in itself is a departure from any of what any of us would have expected. Having said that, the fact is that it also shows, and this is more so how we are thinking about it, when we draw up our plans. The breakup is important to understand. One is that clearly some of these themes, some of these sectors have a far larger representation than it used to have earlier, combined with the fact that the policies and reforms are really been something at the back of every investor and every investment manager's mind, where they have more confidence in terms of backing these themes. Combine that to the fact that the investor in itself has evolved. And let me qualify that statement by first of all saying a large part of it is driven by the returns that they see. But then there is a large part of the investor community which is evolved and who wants to literally participate in some of these themes without really leaving it to the fund manager's discretion. And I think a lot of that is what is driving the thematic and sectoral fund flows.
Ah, okay. I must also point out, I'd completely forgotten about this. There was also an HDFC manufacturing fund that I think came out in this period.
Absolutely.
Yeah. And that I think mopped up over 9,000 crores as well. So there's one large fund house, SBI with their auto fund, there's HDFC with the manufacturing fund.
Yes.
And we're seeing these absolutely gigantic numbers on the thematic side.
Yeah. So my sense is the SBI fund is still not captured in the flows, but it's more the HDFC fund and some of the earlier thematic funds which are getting captured into the flows yet.
Oh, okay. So maybe the SBI fund gets captured into next month's data. So this was largely on the HDFC manufacturing side. So Abhishek, your sense, I mean, these are some of the biggest fund houses that we're talking about. But will we see medium-sized fund houses also keep coming out with more thematics? Is that the construct? Where else would you incrementally going down the year? Where else? Which other category do you expect to see bigger funds coming to?
No, so I can't speak for the entire industry, but I can tell you what we are talking and what we are hearing from some of our peer sets. Some of these sectors and themes, specifically the manufacturing, combine that to maybe BFSI funds for fund houses who don't have that as a separate fund, and healthcare, which essentially are more structural themes and which are pegged to be growing faster than the broader nominal growth of the economy. Are these themes, are these segments which will clearly show its representation. If I may, I would only add, for the benefit of investors to say that just don't get into it because, the near-term returns have been great. Please do review it from a perspective, say, are these broad enough themes? Do they have a larger representative set at the back end? So that these themes and these funds can really be a longer part of your portfolio going forward. And you don't have to keep on twisting and turning when the performance goes through that cycle as well.
All right, Abhishek, we'll leave it at that. Thanks a lot for joining in and sharing with us your insights on the data from AMFI, the data mutual fund data coming out. The big takeaway is the net inflow number, 34,000 crores at a record high. Time for a short break. And up next, we put the spotlight on Heritage Foods, and it's been buzzing for the last 10 to 12 trading sessions. We'll tell you why on the other side.
The GDP growth that we are now projecting for the current financial year 2024-25 is 7.2%, with Q1 at 7.3%, Q2 at 7.2%, Q3 at 7.3%, and Q4 at 7.2%. The risks are evenly balanced. Private consumption, the mainstay of aggregate demand, is recovering. And it is recovering with steady discretionary spending in urban areas. Revival in rural demand is getting a fillip from improving farm sector activity. The Monetary Policy Committee met on 5th, 6th and 7th June. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC decided by a 4:2 majority to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF, rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. Headline CPI continues to be on a disinflationary trajectory. Monetary policy has played an important role in this process. This is evident from the decline in headline inflation by 2.3 percentage points between the first quarter of 22-23 and the fourth quarter of 23-24. Supply side developments and government measures have also contributed to this moderation of headline inflation. Repeated food price shocks, however, slowed down the overall disinflation process. According to our projections, the second quarter of 2024-25 is likely to see some correction in headline inflation.
Back with us here on Trading Hour, and throughout last week we've been highlighting how all these Andhra Pradesh based companies have been on an absolute tear when it comes to share price performance, and one of them being Heritage Foods, which has a direct connection to Andhra Pradesh's Chief Minister elect Chandrababu Naidu, and that stock has been a bit volatile in today's trading session. At one point it was again locked in a 10% upper circuit, then a large transaction took place. We'll talk about all of that, but the direct connection, as I mentioned, is that it's promoted by the family of the Chief Minister-elect Chandrababu Naidu. Now, it became a public company in November of 1996. Now, Chandrababu Naidu, this will be his fourth term as Chief Minister. He's been Chief Minister between 1995 to 2004 and again between 2014 and 2019. Now, during this period, if we look at the stock price performance that Heritage Foods has had, if we can pull the chart up, now it listed in November of 1996. These are annual returns. So, in 1998, the stock had doubled. 1999, it was up almost 4x. Then 2002, it doubled. 2003, it doubled as well, in some bit of profit-taking years in between, and in the second stint as well. Almost at least 50% gains in the first 3 or 4 years there, 80%, 85, 87%, and then 50%, other than the last 2 years when eventually in 2019 he was voted out. Now, in the last 12 sessions, the closing on the 23rd of May was somewhere close to 370. Now, the stock at the highest point of the day was at 727. Now, that was the high for Heritage Foods in today's trading session. Now, what has happened here is that this move that Heritage Foods has had, the year-to-date gains now are at 138%, is the best calendar year that the stock has seen since 2012. Now, what is the connection here? Because Chandrababu Naidu's wife, Bhuvaneshwari Nara, she holds a 24.3% stake, and son Nara Lokesh, he has a 10.8% stake in the company. Now, together, the value of their stake, which towards the end of May was somewhere around 1100 crores, now it's already 2300 crores, considering the rally that the stock has seen. Now, because of this, so that's the move that we have seen in Heritage Foods and the subsequent reflection in the wealth for the promoter family as well. Now, in terms of financials, Heritage Foods for FY24, the main source of revenue for them is milk. Value added products is somewhere close to 30%, and the rest coming from fat products and ice creams. Now, they have also done a lot of new launches recently. As early as the 5th of June, they launched a new range of pure ghee laddus under the Truly Good brand. They also launched a new range of ice creams for kids, and also introduced new packaging formats for the farm fresh milk and for their whey-based energy drinks. So there are a lot of product innovations that are going in as well. They got a new CEO on board as well in 2021 from Coca-Cola. So that is also showing up in the performance of the stock. Now, because of which, and there was a large transaction that took place in the stock today. Just recently, almost 5% equity change stands close to 320 crores at a price of 725. The buyers and sellers remain unclear, but because of this move, if we can pull up the intraday chart, the stock that was locked in a 10% upper circuit at one point of time had a very sharp sell-off and almost turned negative, and then after that it has recovered from the lows of the day. So there you can see the reaction there. It broke out of the circuit, almost turned negative, actually briefly turned negative as well, and then again has recovered from the lows of the day. So 6.5% higher still is Heritage Foods, still up 100% in the last 12 sessions. Pretty strong moves coming in there for this stock as well.
It's had quite a ride, imagine that. I think 14 days, some 94% gain coming through. It's been absolutely stellar. Well, with that, we're completely out of time. Leaving the market just about 50 points higher on the index. Mid-caps also up about 100 points. We'll take your leave. It's a wrap from the Trading Hour team, but do stay tuned because Halftime Report will take the action forward.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.
Stocks trade ranged as Street awaits clarity on the ministerial berths to be awarded to 71 ministers sworn in along with the Prime Minister on Sunday. Utilities, cement and real estate are prominent gainers even as IT drags.
Mahanagar Gas says discussions on getting gas under GST are underway and a rate of 12% is likely. The move is seen by analysts as a positive for the gas value chain.
Zen Technologies and Bharat Dynamics tell CNBC-TV18 they see no slowdown in the order inflow in the defense sector following the poll outcome. In fact, they expect more aggression on indigenization.
Strong US non-farm payrolls data spooks commodity markets with crude, gold, silver, copper and steel bars all sliding lower as expectations of a rate cut gets pushed back.
Prime Minister Narendra Modi and 71 ministers take oath as the NDA government swears for its 3rd straight term. The new cabinet has 30 ministers, including 5 berths for key NDA allies. Portfolio allocation, however, is awaited.
Hello and welcome to Halftime Report. I'm Ekta Batra and with me is Mangalam Malu. Well, today is turning out to be a day where we are trading in a range. It's a bit volatile, you'd have to say. So around 173 points in terms of the Nifty range, or 178 points in terms of the Nifty range is what we've seen today. The high was around 23,411 odd and the low has been around 23,233. So let's see, as of now, just about with a positive bias on all of the key indices such as the mid-cap index, which is up around 0.2%, the Bank Nifty, which is trading with a positive bias, along with the Nifty, which is up around 46 odd points as well. Hi, Mangalam.
Hi, Ekta. You know, you got the color right today. It's green. It's at a record high, but consolidating after a big surge that we've seen. What's interesting, however, is that over the weekend, not only did we get good news coming in from, the Prime Minister's oath-taking ceremony, India winning the game against Pakistan as well, but also monsoons hit the city of Mumbai and a lot of other parts of the country, maybe 2 days ahead of what was expected by the Met Department as well, and that's showing in the kind of stocks which are doing well in the broader markets. We have a lot of these fertilizer, agrochemical sort of stocks which are spiking. Rallis India, for instance, up around 12%. Fact is up around 10%. We're seeing a decent traction in names like Jain Irrigation as well. Of course, all these companies are buzzing around on hopes of good demand this monsoon, good rural recovery, just the way we've seen in a lot of these other consumer names as well. And the other ones which are doing well include the likes of, Raymond, which is up around 6% as we speak. Interglobe Aviation, not particularly bad, with a gain of about 5% as well. And we're speaking about rural recovery, which is the FMCG company that has highest exposure to rural India. It's Dabur. It's up about 1.5% currently at the high point.
Okay, all right. So that's what's taking place in terms of a couple of these stocks in focus. And like you mentioned, the optimism is largely in place for the markets. But nonetheless, let's focus on some stocks now. PI Industries is under pressure as a key customer. QMI has lowered its guidance. Sonal is here with the details on this. Sonal.
Well, they've cut the guidance. Remember, their fiscal year starts from November and ends in October. So that is how we look at the fiscal or the financial year for QMI. Now, remember, they had given a guidance in December, and now in the first half, they've cut it by 9% further, citing issues around inventory destocking and global channel as well in terms of agrochemicals business. Now, remember, PI supplies pyroxosulfone, which is active ingredient for Exigo, which is an important product for QMI. Pyroxosulfone is the largest export product for PI's CSM segment or the export segment, and there have been questions around pyroxosulfone losing its competitive edge or pricing pressure as well. So this has come in as additional or incremental news flow, which is negative for the company as well. Lower guidance is due to global destocking. The company also speaks about how agrochemicals, the sector is facing an issue, and that continues to be the pain point for PI Industries. The management has alluded to these fears in the past, saying that they are expanding their portfolio and there will not be so much dependence on this particular product itself. However, the issues continue.
All right, Sonal, but stay on. There is also a buzz of the gas sector being included under GST. How would that benefit it?
Well, you know, there have been a lot of talks earlier as well, but again, these talks have resurfaced where there could be a possibility of gas coming under GST. In fact, Mahanagar Gas had its analyst meet takeaways where they did indicate that discussions are underway to get natural gas under the GST regime. Comments have been sought by end of June 2024, that is this month itself, on the new central excise bill. Now, remember, right now, the taxation on gas is as under excise duty at 14.5% plus state VAT plus procurement tax. So what happens in this case is input on the inputs there's GST, but there's no output GST, which does not allow companies to take input tax credit, and it leads to higher costs for them. But the company says now they expect 12% GST rate on gas, and this could benefit stakeholders across the value chain. And this is similar to what brokerages have been saying as well. Citi, in fact, last week wrote that NDA could consider bringing gas under purview of GST, which could benefit the entire value chain. IIFL says that they believe NDA could consider this in the next 12 months itself. And if that does happen, it could further improve sectoral fundamentals. So that is basically the gas value chain. Jefferies has been very specific. They say government is reviving talks to include natural gas under GST, which could lower the gas cost by $0.8 to $0.9 per MMBTU. Andhra Pradesh, Gujarat, Uttar Pradesh and Rajasthan are the 4 largest beneficiaries of VAT on natural gas, because that is where we have the major gas fields. Now, GAIL's consolidated EBITDA could rise by 2%. Assuming it retains the benefit in the LPG segment, Gujarat Gas's competitiveness would improve versus propane by 6%, and CNG companies should see higher volumes or higher margins depending on whether they pass on the price cuts or not. But if it does happen, it will be positive, but we'll have to wait and watch, because previously as well, we have seen such rumors.
Indeed, we have seen such rumors previously as well, but right now, this time around, as always, you know, the expectations are running, and behind those expectations, we have these stocks buzzing around as well. But it's also the start of a new month, which means that we, got the May auto sales data from the Federation of Automobile Dealers Association, FADA as we know it, which suggests that sales in May did see a bit of a decline. Two-wheeler sales too have gone down by about 7%, while CV sales have dipped around 9%. The question is, what now? To discuss more on these numbers, we have Manish Raj Singhania, who's the president of FADA, joining in. What would you make of the decline that we saw in the month of May? Was it because of election-related uncertainty, lack of launches, and maybe people are going to, pick up their purchases in the month of June and beyond that? What are your thoughts here?
Well, I would not really rather say it's a decline. Actually, on a month-on-month basis, if we compare, it's a decline definitely. But what we could see in the month of May was, in the month of April, we had this Navratra, as well as, a lot of auspicious days for marriage that led to eventual higher retails. But if you compare on a YOY basis, the auto industry has grown by overall 2.61%. And though PV segment is slightly below by 1%, but that's a very minuscule number. And definitely, yes, in the month of May, the heat wave, the political scenario in India, the elections, they have definitely diminished the retails, especially the heat wave. We did a survey amongst our members, and almost there was a drop of 18% in walk-ins in the showroom. And walk-ins, as we know, they have the highest conversion to retail. So yes, but we were able to compensate that. Dealers were able to compensate that with test drives at the home premises or the office of the customers and all that. A lot of customer-related activities we could execute and come up with a decent number in the month of May. And June, yes, we are cautiously optimistic about June because what the monsoon, the prediction that we are getting is above normal. And Above normal means that there might be also some flooding also in the region. If that doesn't happen, then the retails would be decent. But if flooding happens, that definitely hampers overall sentiment and the retails of the market. So let's see how it comes, but we are cautiously optimistic about the month of June.
Okay, you're cautiously optimistic about the month of June, Mr. Singhania. What does that mean in terms of numbers? If you have to talk about numbers and, when you talk about the passenger vehicles, are you expecting a good single-digit, mid-single-digit growth on a year-on-year basis when it comes to June? Can you give us a sense in terms of specific numbers that you're expecting on the retail end as a whole?
So, yes, expectation is only on single-digit growth. And that too would be led by majorly SUVs. Now, SUVs are totally dominating almost 55 to 60% of the share in PV market. And lack of new launches in the month of June, because most of the OEMs are targeting launches in the just before the festive, that is August around. So lack of new launches, we have to manage with the existing models available with us. And with an ever increasing pressure on inventory, dealers will be pushing stocks to the customers. And what we really need for a good June is we need good handsome scheme from the OEMs, as well as dealers will also be shelling out something definitely there to make the whole month on a positive note, end the whole month in a positive note. Yes, definitely on a single digit.
There are hopes that there would be rural recovery and rural demand is likely to pick up, even as monsoon predictions have been on the normal side. Inflation has been tame for the last couple of months as well, for the last many months. Now, are you seeing signs of that on ground?
Yeah, definitely. I think since last September, October, we have seen a steady recovery of the rural market. Rural market was the most stressed post-COVID due to job losses and revenue losses and all that. And it took time to recover. But eventually with good crop, good support price from the government, good spend in the rural segment, now we are seeing shoots of recovery there, and continuously rural market has been delivering now. And with the expectation of good monsoon and with the ever increasing minimum support price and good quantity and good quantum of crop, we'll definitely see a good rural retails happening in coming months. We in India, we are very sentimented oriented, and a good monsoon would definitely increase the overall sentiments of the market, will turn out to be positive. That is the expectation. And if it really delivers that way, we'll definitely have a good crop, and we can see a better rural market and better rural retails also.
Okay, all right, Mr. Singhania, we're going to leave it on that note. Thanks very much for joining in and speaking with us and giving us all of that perspective. That's the word coming in from FADA. They're cautiously optimistic going into the month of June. They did see an 18% drop in terms of walk-ins this time. That is because of the weather-related issues, so maybe that would probably iron out. We'll take a short break, but up next, we'll be talking to the management of Suprajit Engineering on their new acquisition of a German light-duty cable maker. Stay tuned.
CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
The Indian market markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Welcome back. Well, just about consolidating with a little bit of a positive bias at this point in time. Looks a bit tentative for the markets, just about high by around 30 odd points. Let's see whether that sustains or not. But in the meantime, let's in fact focus on Suprajit Engineering. They have made a new acquisition in Germany of a light duty cable maker. And this is out of insolvency proceedings in Germany. We have Mr. Kumar Rai, who's the founder and chairman of the company, who's joining in to discuss more on this particular acquisition. Mr. Rai, if you could just start by giving us a sense about this company, SCS. You're buying it out of insolvency proceedings in Germany. It has an enterprise value of around 13 million euros. Give us a background in terms of what this company is bringing to the table. If it's in insolvency proceedings, what is the kind of valuation that you bought the company at? Is it a distressed sale? What are the revenues as well as the margins and the profitability of this particular company that you're buying?
Good afternoon, and thank you for having me on your channel. Just to give you a background, Stahl Smith Cable Systems, SCS as we call, is a group of companies headquartered in Germany, but having plants in China, Morocco, Poland till recently, as well as some amount of production in Canada. It's a 100-year-old company. They're one of the leading light-duty cable makers in Europe. What they have done, originally they were all making these cables out of Germany. They decided to move to Hungary to bring the cost down. Then again, they moved to Poland to bring the cost down more. And then as the pressure from customers increased to compete with competitors like us or from China, they decided to move to Morocco. In the process of moving multiple moves of main operating plant, they got into cash flow problems. And that's why the German company, the parent, went into insolvency due to cash flow issues. The plants are in great working conditions. Actually, Morocco plant is a brand new plant. Plants in China is very good. So operationally, they were a good company, but cash flows were the problem. And hence, they had to go into an insolvency proceedings in Germany. And through the negotiation with the insolvency administrator in Germany, we were able to acquire this facility, acquire these assets and companies. So that's the way the whole thing happened. SCS is a light-duty cable maker for most of the leading European as well as US customers. Customers like BMW, Audi, Daimler are the big customers on a tier one, whether it is Magna, Faurecia, Lear, Vita, Drama, they're all their customers. So they have a marquee customer base and a very good, well-accepted product. So I think that made us attractive to us. What really is attractive for us is that through this process, now that there is a Morocco plant, we are able to offer our customers both onshoring opportunities if they want onshore, nearshoring like Morocco is close to Europe, and of course low-cost base if they want either from India or from China. So this makes our supply chain footprint perfect for our customers for a long-term value creation for both customers and us.
Just looking at two things then. First is that the enterprise value of this is around 13.5 million euros. And secondly, you said that this will add around 50 million euros to your overall revenue. So the first point is, how much will you be paying for acquiring this? What would be the increase in debt because of this? And when do you pare that debt down? And second part is, by when do you reach that 50 million euros in revenues?
The revenue run rate today is at 50 million euros for the group. So I expect that to be there intact when we start operating this ourselves. In terms of the enterprise value, you are right, 13.5 million. There are certain debts that is there which will be reduced from the enterprise value after negotiation. The insolvency administrator will be negotiating with the creditors and bringing this down. So the equity value will be lower than that. So the way we look at it is that over a period of time, because it's a two-tranche closure. First, we are closing the European side, including Morocco. And on the second side, we are expecting to close both Canada and China. It's going to be a few months before we do it. That is the time we'll get a correct picture. In terms of the debt, we are not planning to take any new debt. As you know, we have got nearly 500 crores or 450 crores of cash in our balance sheet, and the requirement is much, much smaller. So it's we are not taking any debt, and there'll be no additional leveraging happening at all in this transaction.
Okay. You had an FY25 guidance of double-digit growth and margins. Is that correct for the company?
Yes, that is correct.
Does that change now because of this acquisition? Is there any kind of dilution to this guidance because of, say, integration process, because of, say, their operating leverage that you have to bring on?
What we have guided is for our current existing operations, not for the new acquisition. New acquisition will take another year or so for us to consolidate and do a necessary, streamlining of operations. So when we gave the guidance, it was prior to this thing, and this would be separately also been disclosed in our quarterly numbers as to how they are doing. Over a period of 1 year, I think it will be fully integrated into Suprajit.
All right, so we'll talk about that in a year once it is fully integrated. Just a word before we let you go. Your margins for LDC are in mid-single digits. With all the synergies and cost synergies that you bring with this acquisition, will the margins be higher than that, or will they still be in the mid-single digit mark itself?
The acquisition this one brings is, as I said, the near-shoring, on-shoring and low-cost manufacturing base, a better consolidation of vendor base, and that means at a supplier end. That gives us a leverage to discuss value for money proposals with our customers. So we strengthen ourselves by this consolidation. That is the first and most important part. In terms of the margin, I think, as you rightly said, SCD, that the controls division, is at a mid-single digit thing. We have given a guidance that will improve by itself this year, whereas this will bring additional, tailwind to us over, I think, 1 to 2 years' time.
Okay, an additional tailwind over 1 to 2 years. That's the guidance coming in. Thanks, Mr. Rai, for joining in and giving us that perspective. That Suprajit, that stock is up around 30% in the past 6 months odd. Made an acquisition. Let's see. The integration is probably going to take a year from now on. They're sticking to their guidance of double-digit growth in FY25. We'll take a short break, but up next we'll be discussing technicals. Sachitanan Udekar of Trade Bulls will join in. Stay tuned.
There, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
And what a great way to celebrate our own 25th year, with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. A couple of stocks doing well. United Breweries has hit a record high in trade today as we speak, a big mover, and has been a big mover ever since the election results that have come by the street, hoping for some clarity on regulations in this space itself. Meanwhile, for the markets, we're doing okay. For the frontline indices, a mild tinge of green, back to regular programming after all the events of last week have been done. But for now, today's high on the Nifty of 23,412 is something that we will have to keep an eye out on, because if we're going to consolidate, then maybe this is a level that we'll have to watch out for on the way up. And also the key drag today has been the Nifty IT, and that perhaps on account of news coming in over the weekend from the US of higher than expected job additions, so no respite coming in from a rate cut front, and that has its bearing on the IT pack after a good week that it had last week. The third thing that we have to look at is the Nifty Bank sustaining above that 50,000 mark, because that is something that it has been crossing a couple of times all through last week and even today, but it's not sustaining above that. For the Nifty, active call options are 23,500 and active put options are 23,200. Both of them together telling you that maybe the street is positioning itself for a range of around 23,000 at the lower end to about 23,500 at the upper end itself. Stocks which are seeing long positions being added, Ramco Cements and Mahanagar Gas. And finally, just keeping an eye out on India Cements. All the cement stocks are doing well today, but India Cements may enter F&O ban because of the open interest activity out there.
Okay, all right. That's on the F&O space. Thanks, Mangalam. For that, Suchitanand Utikar joins in to discuss the technicals now. Suchitanand, thanks very much for taking the time out. It's a bit of a volatile day. We have the Sensex, which has now slipped into the red. How would you approach today's trading session? What would be the key specific stocks to play this market?
Good afternoon, Ekta. Good afternoon, Mangalam. I think clearly markets are oscillating within a tight range of 23,400 to 23,200. And if you look at the data, there is multiple evidence that Nifty has a good amount of support near to that 23,200 mark. So even if we see a decline, I think that decline should be bought in unless we don't see Nifty closing below the 23,170 zone from here on. The trajectory for the trend remains on the bullish side. So we are anticipating that eventually we may see a further expansion of this particular move, and even from a trading perspective, markets could scale towards 23,560. So I think the buy on decline strategy should be should be continued. When it comes to Nifty Bank, the immediate range is around 49,500 to 50,560. Even here, I think it is sustaining well above that 50,000 mark. So the probability is high that we may see banking again contributing in the second half, and probably we may see a swing towards 50,560. So overall, I think markets are stable. They are just consolidating before the event announcement. And if you look at the price action, it is giving us that confidence that we may see a further, legs on the upside.
Right, and individual stocks?
Mangalam, the focus is now on some of the chemical fertilizer space. For a very long time, we have seen SRF oscillating within the band of around 2000 to 2700. So what we have already observed is that there has been a very good shift in this particular band, and there's a good sign of fresh support built up somewhere close to around 2300 zone. Now, if you look at the weekly formation, we have a bullish hammer formation on its weekly scale last week, and the daily RSI has started trending comfortably above that 50 mark. Even its 5 and 20 exponential moving averages have given a positive crossover, so that's why we are anticipating that SRF may again move back to that 2700 zone. So from a trading perspective, we have a price target of around 2500 on the higher side. The stop loss can be placed somewhere close to around 2310 from here on a weekly closing basis, and fresh long positions can be added. Our disclosure that would be that we have also recommended this trading position to our clients. The other stock on our radar has been Chambal Fertilizer. Now, if you look at the weekly structure, the stock has been comfortably trending above its 5-week exponential moving average for almost 11 weeks now. On the weekly chart, it looks like a classic bullish flag formation, which is again a continuation of a trend signal. So we are anticipating that this particular move may extend eventually towards 475. But from a trading perspective, we may see an immediate swing towards 440. And that's why we are recommending building long positions in Chambal Fertilizer. And one can keep a stop loss somewhere close to around 410.
Okay, all right, Sachidanand, we're going to leave it on that note. Thanks very much for joining in and giving us all of those technical calls for the markets, like we mentioned, just about consolidating at this point in time. The advance decline ratio a little bit on the advancing side. So let's see whether that sustains. Over 2,700 stocks advancing, 1,286 stocks declining on the Bombay Stock Exchange. Quite a wide gap. Let's see. Seems as though it could be a day where it continues to be this way. We'll take a short break, but up next we'll be talking to a KEC International to discuss their new orders backed by the company. Stay tuned.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
So the whole debate was whether you should be unloading of PSUs, unloading of capital goods, manufacturing, infra, and moving towards defensives. And we saw that on Tuesday. There was this massive rush for safety. So anyway, let's talk about valuations and how these numbers have absolutely converged. It's been a story, a study in itself. So these are numbers FY26 for some of the prime capital goods stocks. And many of them are, of course, MNC companies. So ABB is right at the top of the pack, 92 times. Hitachi Energy 78 times. And look at the corresponding moves in stock prices. Valuations are up because these have become growth stocks. At one point in time, they were value stocks. But look at the appreciation. Hitachi Energy is up 163%. Siemens and CG Power, they've done really well. 80%, 90% growth in these stocks in the course of the last 1 year. Thermax 127%. And look at GE T&D. 535%. So valuations on these capital goods names, which are many of them are MNCs, they're ranging anywhere between 50 times, going all the way up to almost 80 times for some of the names like ABB. Now, contrast this with FMCG. FMCG was the original sector that would trade at 70 times. Those were the heydays of the staples era. But now that's changed. So Nestle is the one that's, if these are FY26 numbers, by the way, that I looked at. So about 60, 61 times on Nestle makes it the most valued stock. Godrej comes in at a second at about 50 times. Lever, so these valuation multiples, they've been trending down. Lever itself is at 50 times. They're obviously at a discount to what the historic averages were. Colgate at 48 times. And look at the stock price performance. Lever hasn't moved. I mean, throughout the year. The others are up anywhere between 7-8% to about 11-12%.
Welcome back. You're watching us here on Halftime Report. Bottom of your screen, important flashes coming in as the street awaits clarity on who gets what. Subramaniam Jaishankar, S. Jaishankar as we know him, likely to retain the Ministry of External Affairs position. So that's news that has come in from our correspondents. We'll try and get more details on this one, apart from all the other that we're awaiting right now as well. And as we do that, let's also focus on some individual names. KEC International is a stock on our radar. The company has secured orders worth nearly 1,000 crores, a little over 1,050 crores. And the order intake in this year so far has crossed 3,000 crores. This year, as in this financial year. Vimal Kejriwal, who is the MD CEO, joins in now. Thanks a lot, Mr. Kejriwal, for joining in. Always a pleasure speaking with you. Remember the last conversation we had, you had fallen short of the 20,000 crore order inflow guidance for FY24, and you upped that by saying that this year, FY25, you'll get 25,000 crores. We're not even done with the first half of the first quarter, and you've done 3,000 crores already. So just wanted to know if 25,000 crores is still the target, or you'll do better than that?
I think we'll still stick to 25,000 as of now. 3,000 is orders which we have got spread across civil, railways, transmission. We still have a large 8,000 crore L1 with us. And these are mostly orders which are, which will happen now that the elections are over. Many of them are awaiting approvals and announcements. So we are, I think, comfortable with 25,000. Do we want to up it? I think it's a little bit early for that.
Okay. And you're sticking to that guidance of around 15% revenue growth in FY25. Is there any upside to this also?
Difficult to say today. I think it's, again, I'll say a little bit early. Let's see how the ground realities shape up. How do the supply chain issues, get resolved? Supply chain issues get resolved. We'll see if we can do more. But otherwise, I think it's a fair number which we have given of 15% increase.
Just wanted to understand that what is taking place in the railway business, because you all did have some challenges there when it came to execution delays, some kind of supply chain constraints. Are you expecting that to probably iron out in FY25? What's the on-ground situation there and your guidance on the segment?
Ekta, what is happening is that most of our old projects, as we call legacy, should now be getting over slowly one by one. So that part will get over. We have started securing orders. In fact, if you look at the orders announcement which we made, 1,061 crores, that's almost 40% of railway orders. One is for conversion, gauge conversion, and one is for power supply to metros. We do expect that with the new ministry coming in, and with a little less focus on political gains, I think we'll see a lot more spend happening on infrastructure, and also focus on completing the infrastructure project, which should help us in sort of clearing up the issues which are stopping the execution. So we do expect that railways should start turning around this year.
Railway turns around this year. Also, the SAE business, which turned around last year by being a bit positive for 4 quarters in a row. You expect that momentum to continue. With all of that happening, would you, hold on to that 7.5 to 8.5% sort of guidance? Would you believe that it will be closer to 8% this year in margins?
So Bangla SAE was PBT positive all 4 quarters last year. And they have an L1 plus order book of almost 3,000 crores. They are well placed. We had a very large auction in Brazil this March. And we are very well placed with some of the developers. So I think SAE should do well. I think our guidance right now is at 7.5%. And I think I'll come back to what Ekta was talking about, whether you want to stick to 15% or not. I think both of them are tied together. If you are able to, push more execution on the newer orders which are coming at a better margin, then obviously there could be an upside. But I think as I said, I'll wait for some time to comment on that.
What is the downside risk to this guidance? What are you probably most concerned about going into FY25, which could be a headwind for you all?
So downside risk, I think, continues on the geopolitical side. Although we have factored all the Red Seas, etc., into this. Most of our metal exposures are hedged. I think the only piece which is unhedged for us remains steel, which is not very easily hedgeable. So if suddenly, let's say, the steel price shoots up or something like that else happens. Otherwise, I think this year we are pretty comfortable with our numbers, both in terms of revenue growth as well as margin growth. I don't see, honestly, any big risk for these numbers.
What's your L1 position right now? I mean, the last time we spoke, it was 5,000 crores, of which you've got 3,000 crore worth orders coming in already. What does it stand at now?
So you're talking about the L1 position. We are at 8,000 crores now.
8,000 crores. And if you could...
We are at 8,000 after this 3,000. Okay.
Right. So, and what's the breakup of these orders that you have, or rather L1 positions that you have right now?
So they are all in the transmission T&D sector, everything. I think roughly half of it is in India, or slightly less than half of it in India. The rest is international.
Okay. In terms of the international segment, Saudi Arabia, UAE, USA, which would probably be the geography that you're expecting the highest growth from? Because you seem to be quite, bullish on this international T&D prospect. So within the geography, which one do you think you're probably going to bag the most orders from, which you're bullish on?
So it would be between Saudi and UAE. I don't know which one will get more orders, but between the two, I think we should get a lot of orders. US, there's a huge market, but for us, it's a supply market. So it's constrained by what I can supply to them. Otherwise, I can take more orders in US, but I don't think I'll be able to do too much more in US.
Right. And just before we let you go, you did give us a breakup of what your L1 position is right now, all of them nearly T&D. Of this 25,000 crores orders that you are expecting in this year, what would the breakup be? What comes from what segment and then materializes into revenue? So the mix?
So broadly, 50% of this, or maybe slightly more than that, will come in from T&D. So 12,000, 13,000 crores would come from T&D. Another 6,000-7,000 would come from civil. And the balance would be split between railways, cables, and renewables.
Okay. All right, so we're going to leave it on that note. Thanks very much for joining in and talking to us. And I'm sure we'll touch base with you to get a sense in terms of how the year is progressing and whether you're sticking to that guidance or not. Thanks very much for joining in. That's KEC. The stock is doing well today, up around 5.5%. We'll take a short break. On the other side, we'll focus on some more stocks which are buzzing today. Stay tuned.
Better. Marico, for instance, slightly better. But even here, the valuation multiples have all come down to the 40s, mid-40s. And it's the capital goods space where the valuations have moved up to 80 times. And that's the change that we're talking about. Whether this event that happened, whether that offered a bit of an opportunity for a reset.
He was the man of the week itself, right? He's got close to around 16 MPs, and he was a kingmaker actually. And who would have thought? Now, there are a few stocks that are moving around based on the so-called Naidu effect. Heritage Foods, he's the promoter entity in there, and just looking at it, well, the fundamentals as well of the company have been improving, or that's what the street believes as well. So the last year they did around 11 rupees, but the next couple of years the street believes that it's going to go to 22 rupees. So they believe there's going to be an improvement on ground. Looking at the valuations, even after this 50% move that we saw in this week itself, well, it trades at close to around 31 times. The 5-year average is around 29 times. So in that context, it's not very, very expensive. What is the street factoring in? How come the EPS goes up by so-and-so? They are expecting the value-added products, that was around 30%, to scale up to high 30%. How is that possible? Well, they have been mentioning this, in their con calls as well as in the presentation that they put out. Also, they had some high-cost inventory of, SMP. And out there as well, they are expecting that, in fact, that high-cost inventory will be out of the way. And if you just look at the margins, well, they've come down drastically to around 5% in comparison to around 11% odd. So both of those are the triggers that are going to be working for it. And that's why the margins are expected to improve from here. And that's why the EPS as well is expected to move from here. Well, next up, let's move to Amara Raja. You have Mr.
Welcome back. Well, let's talk about some more stocks in focus. Suzlon is down in trade today as the company's independent director has resigned, as well as due to some brokerage commentaries coming through. Vamakshi is here to give us all of the details on Suzlon and the reason for its sluggishness today. Vamakshi.
Well, absolutely. Suzlon is reeling under pressure today after the company announced that its independent director, Mr. Marc Desailly, has resigned with effect from June 8, 2024. Now, keep in mind that he was associated with the company since April 2012 and his term was expected to end in September 2024. But the reason that he has given for this resignation is as follows. He says that corporate governance standards standards that were applied did not meet his own expectations, including situations where communications lacked his expectation of openness and transparency. Now, in the con call, however, the management clarified that the issues that were raised were soft in nature and were process oriented and were to be implemented in due course. They also reiterated that all legal and financial disclosures have been fully complied with as per regulations, and they also said that none of the suggestions revolved around financial or operational irregularities or non-compliance with the law. So this is a very important point made by the management. And in fact, we had a brokerage note that came in from Nuvama. They said that the company is turning around its financial position and operational ramp up is expected to come through in FY25. The management is also looking to address the needs of the business, and therefore they intend to implement best-in-class suggestions in due course. So overall, they've kept their buy rating unchanged. They've kept their target price, which was at 53, unchanged largely, but despite the commentary that came through from the management, the stock is reeling under pressure on the back of this announcement.
Take that point. The stock has been a big mover on the way up as well. Vamakshi, take your point on these developments out there. We'll of course keep a close eye on how that pans out. That's about today. But if you take a longer term chart, you'd see that it's been a big mover from lows of sub 10 rupees. I remember 18 months ago, all the way up to 47 rupees where it is right now. But monsoons are here, and that also means that the summer season has come to an end. It was a scorching one at that. So good time to get in a roundup of what consumer durable makers did in this summer. 3 years of subdued demand, remember. So the industry has seen a record growth for this season. Good brands doing a lot better. We have Shilpa Ranipeta joining in with more exclusive details here. Shilpa.
Well, it's been a bumper summer for consumer durable makers. Now, remember, like you said, 3 years of decline in sales they've seen, whether it was summer or festive seasons, where they see bulk of their sales coming in from. Now, this summer, the white goods as an industry, it saw record growth of about 25% in the March to May, which is the summer period of this year. And this was on the back of a severe heat wave that we saw across the country. Now, AC segment, for instance, grew between 25 to 30%. And the Consumer Electronics and Appliance Manufacturers Association expects that 13.5 million units of ACs will be sold in 2024, and this is against about 11 million that were sold last year. Now, refrigerator segment also saw about a 20% growth. Now, remember, this growth comes on the back of last year, where there was a decline of nearly 25 to 30% because of unseasonal rains as well. And this year, it's not just the premium, but the mass segment also has bounced back after several quarters of seeing a decline. And in fact, the unprecedented growth has also led to supply constraints. Some brands have been struggling to meet with the demand, and as a result have had to ramp up production. And this against the situation last year, where some brands had to cut production because they were not able to meet the demand. Now, this is at an overall industry level. If you look at some of the brands that did exceptionally well, Godrej Appliances, for instance, says that its entire cooling appliance segment grew by 60%, and ACs grew about 150% this summer season over last year. Refrigerators grew about 40%. The air cooler segment saw 2x growth as well, and they also had shortages in certain SKUs and models due to unprecedented demand. If you look at Vijay Sales, which is a retailer, and it sees demand from across, it sells across brands. They saw 60% growth for ACs, about a 60 to 70% growth for air coolers, and refrigerators grew about 20%. And they say that the consumer durable industry this year could see a